Okay. Okay. All right. Good morning, everyone. Welcome to our last session on Ind AS 33 that we have been discussing over the past 2 to 3 sessions. Okay. So far we have discussed what is earnings per share, why this has been a very important standard. We have discussed in detail about basic EPS, which covered discussions on what should go in the numerator part, what should go in the denominator part. Numerator basically is net profit attributable to equity shareholders. Whereas the denominator is your weighted average number of equity shares. That is equity shares in issue weighted for time that they have been in issue. Then we discussed the concepts of basic EPS surrounding bonus issue as well as rights issue. Basically, these involve shares which are issued without addition to resources of the company. In the case of bonus, there is absolutely zero addition to resources, and in spite of that, bonus issue are done, shares are increasing. Whereas in the case of rights issue, there is a consideration that is received at a discount to the fair value. So therefore, there is a bonus element or a free element in the rights issue. So we would compute the basic EPS for the current year as well as restate the EPS for the previous financial year, the comparative EPS, by applying the bonus adjustment factor or the rights adjustment factor as the case may be. Okay. Then we moved on to something known as diluted EPS, which is basically EPS after considering all the potential equity shares in the capital structure. Okay. So very important concept. It is giving a forward-looking idea of how worse can the EPS go. How worse can the EPS go? So this is from the perspective of the final shareholder. Okay, the shareholder who has the interest in the residual net assets, the residual interest after deducting all liabilities, all preference shareholders claims, deducting everything what is left, it is computed from that person's perspective. So these were what we had discussed. All right. So with that background, let us then proceed to further discussions on diluted EPS. We still have a couple of concepts to discuss, and then we shall move on to EPS with financial instruments. We have 2 questions, and then we have 1 question on EPS in the case of consolidated financial statements. Okay. So with that short revision, let us commence our discussion on the next part, that is options. Okay. So options, what I'm going to do is I will discuss it with the help of a question that is there in your study module. Okay. So options or warrants means what? These are instruments which are issued to the shareholders, which give them the right to subscribe to the shares. Okay, they already have shares and they have some options. So these options give them the right to exercise the option and get shares. Okay, options could be issued to existing shareholders, could be issued to employees also, in which case it would be called as employee stock options. Okay, so now look at this question. This is your study module, test your knowledge question. 1st January, the number of shares in issue is 10 lakhs and profit for the year ended 31st December is 1 lakh. Average fair value during the period is rupees 8. The company has in issue 2 lakh options to purchase equal number of ordinary shares with an exercise price of rupees 6. Calculate the diluted EPS for the period. Okay. So now they've told diluted EPS. If I proceed with the basic EPS first, basic EPS is rupees 1 lakh. These are the profits divided by 10 lakh shares. 10 lakh shares. So that comes to rupees 0.10 per share. That comes to rupees 0.10 per share. Okay. So fairly simple, no discussion. No doubt in this. Now we move on to diluted EPS. What do you understand by diluted EPS? Well, we will have to factor into account all the potential equity shares in the capital structure of the company. So what are my potential shares? Well, if you look at this, there are no convertible debentures, there are no convertible preferences, but there is something known as options. These options represent potential shares. Each option in this problem is getting converted to a same equal ordinary share. That means if I have 2 lakh options, then I will have 2 lakh ordinary shares. So then what are you? Now if these options get exercised, will there be any savings in my cost? Like when we did convertible preference shares, there was a saving in preference dividend. We used to add that. When we did convertible debentures, there was a saving in debenture interest. So we used to add interest net of the tax effect. When I talk about options, is there any saving that is happening? Answer is no, there is no saving. Sir, why no saving? Because you don't pay anything to your option holders just because they hold an option. Just because they hold an option, you don't pay anything. So when that is the case, my diluted EPS starting point is my basic EPS. So net profit is 1 lakh, but nothing is payable to my option holders. And therefore, on that front, I'm not going to save anything. Why you are not going to save anything? Because you don't have to pay the option holders anything. Divided by, here you are having 10 lakh shares. And what is the number of options? Sir, number of options is 2 lakh. Number of options is 2 lakh, each of them equivalent to 1 share each. So therefore, 2 lakh shares. And if you proceed to do like this, your answer is incorrect. Your answer is incorrect. Sir, why 2 lakh shares is incorrect? When we used to do convertible preference shares or convertible debentures, that point of time, we always used to take, we always used to take the number of shares on conversion. So if the preference shares conversion ratio was 1:1, we have taken the same number of equity shares in our diluted EPS calculation. Whatever be the ratio, we have applied. So here also, if you have 2 lakh options, we should be taking 2 lakh shares. Why are we not taking 2 lakh shares? There are 2 ways we can understand this. Okay. The main important thing is on exercise of options. Okay. On exercise of options, what is the journal entry that you will pass? The journal entry that will be passed is bank account debit to equity share capital to securities premium, if at all it is more than the face value, which generally it will be. Okay, to securities premium. Now, when I talk about conversion, okay, on conversion of preference shares or debentures to equity share capital. Okay. On conversion, what is the entry that you are going to pass? Sir, the entry will be preference share capital account debit or debentures account debit. I'm just forgetting financial instruments for the time being. To equity share capital to securities premium. Now tell me, what is the difference between these 2 entries? What is the difference between these 2 entries? What is the difference? Yes? Come on. What is the difference between these 2 entries? What change or what is the element that is making this entry different? I think who all are watching? Mahinder used to watch. Then Sairam used to be there. Then Vidula, Srinidhi, Tanushri. These are the usual ones. Jay Srivastav. Bank, yes, Jay Srivastav gave the answer. This is the differing point. This is the differing point. When you issued convertible preference shares or when you issued convertible debentures, the money was received at the time of issue of those instruments. When you issued preference shares or when you issued debentures, the money was already received at that point of time. It's not being received now when the instruments are getting converted. The money was received at that point of time. And because the money was received at that point of time, that money was put to use in your operations. It could be acquisition of fixed assets. It could be repayment of whatever, but it is put into use in the business. And because it has been put to use in the business, these instruments have started to fetch profits, or what you call returns, right from date of issue of convertibles, okay? Because when the convertibles were issued, they were in the nature of debentures, they were in the nature of preference shares. So that time only you got the money, you used that money in your operations, and therefore they already started to fetch the profits. You could not ignore the receipt. Why? Because bank mein paisa aaya hai. Actually, money has come into the bank. But in the case of options, regular options, did you receive the money in the bank account when options were issued? Did you receive the money in the bank account? No. So, money, that is consideration not received when options were issued. Consideration was not received when options were issued. When are you going to get the consideration? You are going to get the consideration not when you want it. You are going to get the consideration when your option holder wants to exercise the option. So, in this case, consideration received when option holder exercises the option. In other words, can I say that is not when the company needs the funds. Option holder will tell, today I want to exercise the option. That time the company will get the money. Company needs the money, suppose on the date of issue of options. Option holder will say, I don't want to exercise the option, so why should I pay you? So consideration is received when option holder has the wish to exercise, not when the company needs the funds. In the case of convertibles, when are you going to get the consideration? Consideration received on the date of issue of instruments. Not on conversion, mind you. So in this case, the conversion is received when the company needs the funds. And because of this reason, the money in the case of convertibles is already put to use. The money in the case of convertible instruments is already put to use right from the date of issue of the convertibles. Okay, so is this part clear, everyone? Yes, is this part clear? So therefore, in this case, profits earned by the company is after excluding consideration received on exercise of options. That is whatever profits are earned till now. अभी तक जितना प्रॉफिट मैंने कमाया है, उस प्रॉफिट को मैंने कहां से कमाया है? मैंने ऑप्शन होल्डर के पैसे से नहीं कमाया है, मैंने कमाया है अपने दूसरे इंस्ट्रूमेंट से. सो प्रॉफिट्स अर्न्ड इज आफ्टर excluding, this is important, it is after excluding consideration received, and therefore if the profit is without the consideration of options, the profit so far is without the consideration of options, can I now give me the answer to this? You should be able to understand this now. Okay, so now can the entity consider the instruments at fair value in capital in Wayne's calculation for diluted EPS? Now you tell me, what is diluted EPS? Sir, diluted EPS is all the potential equity shares are considered. All the potential equity shares are considered. Now, when I discuss the potential shares, I have to look at what is the what you can say impact on my profits. My option holders have not at all impacted my profits. They did not pay anything. They just have an option to exercise the options and purchase the shares. So therefore, when I issued the options, I did not get any money. The company did not get any money. Whatever money it has received is without the option holders' money. So whatever profit it is generating is without the option holder contributing to it. So when I do the Wayne's calculation, should you consider the instruments at fair value in Wayne's calculation as far as options are concerned? And Vidula has rightly said that the answer to that is no. The answer to that is no. Whereas in the case of preference shares or debentures, profits earned by the company is after including consideration received on issue of convertibles. And therefore, if I have to say, should the entity include all potential shares in Wayne's calculation for diluted EPS? In this case, the answer is yes. In this case, the answer will be yes. In this case, the answer will be no. And therefore, when I consider the options, I will not include those instruments which are at fair value. Sir, then what are you going to include? Well, I will include the bonus element. Which is present in the options. Here, the bonus element is always present. So now, when I give an option, why do you think the option holder will exercise that option? Because he will exercise that option because he will benefit from the exercise. That means what? Market price or fair value of the share will be high, but the exercise price will be low, which is the same in this question. Average fair value is ₹8, whereas exercise price is ₹6. So do you think the person who holds the options is in an advantageous position? Yes, he is. He can buy the option, he can exercise the option, pay and acquire the shares at ₹6 and ultimately sell it for 8 rupees. So therefore, who is benefiting from exercising of the option? It is ultimately the shareholder. It is ultimately the option holder who is benefiting. Company gets money, but wo to ab ki baat hai. It is the money that is flowing in today, right now. But ultimately, who is benefiting? It is the option holder who is benefiting. So if I have to look at the free element in the option, what is available at 8 rupees, I am giving to the option holder for only 6 rupees. I am giving to the option holder for only 6 rupees. So that 2 rupees element jo hai, that constitutes a free element. Now, how do I compute the free element? Okay, so how do I compute the free element? So it is going to be something like this. Free element in options. Free element in options is going to be something like this. Okay. Shares issued on exercise of options. You can just note this down if you want. Minus number of options into exercise price. This is proceeds received divided by average market price. Average market price. So in this case, I am having 2 lakh shares issued on exercise of options minus each of these 2 lakh shares when they were exercised. The entity got 6 rupees. But what is the market element? The market price is 8 rupees. So this is going to be your free element in the options. This is going to be your free element in the options. So that comes to how many shares? That comes to 50,000 shares. That comes to 50,000 shares. Is it okay? Have you understood options in totality? Yes. Tanushri, yes. Vidula, Jay confirmed the earlier ones. Have you understood why are we taking the free element in the case of options? Are yes or no? I gave him 2 lakh shares, but out of 2 lakh, 1 lakh 50 is at fair value. 2 lakh into 6, I am getting 12 lakh rupees, but those 12 lakhs are worth at rupees 8, 1 lakh 50,000. That means, in effect, I have issued 1 lakh 50,000 shares at fair value. Matlab kya hai? What does it mean? This 1 lakh 50 I issued, but did you get the consideration earlier? You did not get the consideration earlier. You are getting the consideration now. You have earned the profits without receiving this consideration. So you cannot take this 1 lakh 50,000 shares in your veins. Ultimately, you are issuing 50,000 extra. That is like the free element or bonus component in your options. And therefore, it is this 50,000 shares which will go and sit in your veins for the purposes of diluted EPS. Have you understood now? Yes, sir. Tanushri has confirmed. So therefore, what will I have here? Sir, you will have here 50,000 shares. So this gives you how much? 1 lakh divided by 10 lakh 50,000. 0.095 per share. Compare this with the basic EPS. Compare this with the basic EPS. Is it falling? Basic was 0.1, diluted is 0.095. So is it falling? Yes. And therefore, this becomes your diluted EPS. This becomes your diluted EPS. समझ में आ गया options? Okay, means option getting in discounted rate, that discounted part is considered as bonus. Yes, bonus, or what you can call is free element in the options. Absolutely right. Sir, why this 50,000 is considered as a part of veins? It is veins only for diluted EPS, not for basic EPS. Now, why it is considered? Because, okay, if you have not understood this, let us look at another way to understand it. Okay, अगर ये आपको समझ में नहीं आ गया, try to answer something like this. Okay, look at it. Now, consideration, this is the alternative method. Okay, consideration received 2 lakhs into rupees 6 is equal to 12 lakhs. Okay, now, did the company need these equity shares? Did the company need this consideration of 12 lakhs? No. Company wanted the money. Company would have issued instruments that required immediate payment. This is an option. Who needs the shares? It is the option holder who needs the shares. The company does not need this money. That is why it gave options. Okay. आपको जब exercise करना है, आप करो. मेरे को अभी पैसा नहीं चाहिए. This was the intention that the company had when it gave the options. Today, the option holder exercised. Did the company want 12 lakh rupees? No, it did not want. But because they exercised, the company got 12 lakhs. So what will the company do? The company will, notionally you think, notionally, okay, मतलब ये hypothetically, company will buy back shares. How many shares can it buy back? Well, it received 12 lakh rupees. It can buy back shares from the market by paying the market price only, which in our question is rupees 8 per share. So therefore, notionally, the company can buy back 1,50,000 shares. And therefore, the shares that will remain is equal to 2 lakh minus 1,50,000. So this is 50,000. This is 50,000 shares. This is 50,000 shares. Okay. So therefore, this shares that will remain in the capital structure is 50,000, which is exactly this 50,000. It is as if when you gave the options, considering today's price, 50,000 shares were always in issue, and that is why it is considered in veins. It cannot be considered in basic EPS because basic EPS considers after conversion. It considers the shares issued after conversion. It will not include potential equity shares. Okay. It will not include potential equity shares. Okay. So this is how you are going to do the calculation. The first method, I tried to explain logically the reason why options we include only the free element. The second method, we saw the alternative understanding wherein the company does not need the money now, but it got 12 lakh rupees. So what will it do with this 12 lakhs? It can do many things, but those are all subjective. We will think from a simple approach that it will buy back shares. How many shares can it buy back? It can buy back 1,50,000. It issued 2 lakhs. It can buy back 1,50,000. So 50,000 shares will remain in the capital structure. And these were always there. So therefore, it will go in your veins calculation. Jay Srivastav, I hope you understood that. Sai Ram is right. Manikanta, sir, I'm in CA final. Can I refer these lectures? Yes, but I don't know the syllabus of, I'm in CMA final, but I'm not sure about what is the depth that is there. You can definitely watch this. Okay. You can definitely watch this. You please have a look at your syllabus to see which Ind ASs are there for you, and accordingly you can have a view. Okay. It's a free resource available to everyone. Okay. Okay. Now, Kumar Mangalam is saying this means it simply calculates like options number. Yes. Into profit in price divided by original market price. Yes. Yes. Okay. That's right. So option number 2 lakhs into, what are you saying? Profit 6 by 8. That is the number of equity shares that are issued at fair value. Okay. Even no resources for 50,000 shares. Still for diluted, we will consider the same. Yes, you will consider the same, because it is like saying, for the consideration of 1,50,000. Jay, look at this. For the consideration of 1,50,000 shares, you are issuing how many shares? You are issuing 2 lakh shares. That means what? You are issuing 50,000 shares without a resource. And that is why you will have to consider the same. Yes, for 50,000, you will treat them as shares, potential shares, which are there in the capital structure only for diluted EPS. Mind you, basic EPS, I'm not considering the impact of options, because they can be considered only when they are actually converted, only when they are actually exercised and you have shares in the capital structure. Is it okay, Jay? Did you understand? Sairam is saying we are getting the money on 1,50,000. Exactly my point. When are you getting the money, Sairam? On 1,50,000 shares. When are you getting the money? Sir, I am getting the money today when the option holder exercises. That means in the profits that I have earned so far, is this 12 lakhs contributing to that profit? It's not. When this 12 lakhs is not contributing to that profit, how can I consider 1,50,000 shares in the capital structure? I cannot consider, na Sairam. I did not get the money. When I didn't get the money, the option holder did not contribute to the profit. And because he did not contribute to the profit, how can I take 1,50,000 in the capital structure? I cannot. Okay. So therefore, what is the differential portion? I gave more than 1,50,000. I issued him 2 lakh shares. So that 50,000 element jo hai, that is shares that will be issued without consideration. Okay. It is like a free element. And therefore, we will consider only 50,000 in the option calculation. Sairam, is it clear? Yes. Okay. Jay ka doubt is sorted out. Yes. So 2 lakhs into profit in price 2 by 8. That's right. Kumar Mangalam, I read your query now. Options number into profit in price by original market price. Absolutely right. You can take it like that also. All right. Now, a couple of observations. Sir, will this 8 rupees be the same? It won't be the same. Tomorrow it can be 10. Tomorrow, day after tomorrow, it can be 5. Day after tomorrow, it can be 13. The prices keep on fluctuating. So when the prices keep on fluctuating, will my free element in the options also change? Definitely it will change. Na? Usme doubt kya? What is the doubt in that? So therefore, will I need to do a restatement of previous year's EPS? No. Because previous year's diluted EPS is based on the market price that was present in the previous year. That is a fact. So whatever be the statement of diluted EPS calculation, that will continue as it is. In the current period, based on the current market price, you will take your calculations accordingly. Okay. Let me take just a short, a detour and slightly modify this question for you. Okay. All right. Now, suppose if market price is equal to rupees 4. Exercise price is equal to rupees 6. Okay. Abhi koi rational investor hai. If he is a rational option holder, he will not exercise this. Okay. He will not exercise this. But suppose hypothetically, this fellow exercises it. Yes, this fellow exercises. Now, when he exercises, What will be the free element in options? Well, 2 lakh shares minus 2 lakhs into, I am going to get rupees 6 out of him divided by rupees 4. So now when you do this calculation, 2 lakhs into 6 by 4. So that comes to 3 lakhs, and therefore this goes negative. This goes negative. What do you have to do when it goes negative? Academically, you can take the negative figure. Here it comes to minus 1 lakh shares. Here it comes to minus 1 lakh shares. Minus 1 lakh shares means what? This is as if the company has bought back the shares. As if the company has bought back the shares. They could look at it logically. Is the company benefiting when the option holder exercises this option? Definitely. The company is getting 6 rupees per share when the market price is actually 4. So the company is benefiting. So it can buy back additionally 1 lakh shares. It can buy back additionally 1 lakh shares. But when it buys back notionally additional 1 lakh shares, what does it mean? Ultimately, your denominator goes down. Ultimately, your denominator goes down. And because your denominator goes down, your diluted EPS will start to rise. Your diluted EPS will start to rise. So now notionally, if I proceed to solve with minus 1 lakh shares, my diluted EPS will look something like this. 1 lakh was the profit divided by 10 lakh shares minus this 1 lakh, minus this 1 lakh shares. So that comes to how much? Rupees 1 lakh divided by 9 lakh shares. So 1 divided by 9, 0.11. This is your diluted EPS. Now compare this EPS with this basic EPS. Diluted का क्या मतलब है? Diluted means the EPS value should be lower than the basic EPS. Is it lower? No, it is higher. So what is it? It is anti-dilutive. Why did it become anti-dilutive? Well, it became anti-dilutive in the first place because of this 1 lakh shares. What is this 1 lakh? The free element is coming negative. The free element is coming negative. And therefore, alternatively, what is the view is, when it goes negative, ignore the negative figure and take it as 0. Ignore the negative figure, take it as 0. Take it as 0. So therefore, this will be 10 lakhs and this will not be 0.11. This will be 0.10, which is very much the same as your basic EPS, and you report this. Okay. So this is how the things work if by chance, heaven forbid, your free element turns out negative. Okay. All right. Sir, if options are issued during the year, but profit is not final, then will the options be considered in the veins while calculating EPS? Look, Sairam, you are calculating the EPS at the end of the year when the profit is final. You have frozen the profit figures now. Okay. So whenever you issue the options, that's not important. What is important is at the end of the year, whether those options are there. If they are there, they are potential equity shares. And if they are potential equity shares, you will have to include them in your veins for the purposes of diluted EPS. And when you reach the EPS, obviously your profit figures will be finalized. Okay. Will be finalized. If the options are exercised during the year, then at the end of the year, there are no options, right? Suppose now these options, suppose these 2 lakh options were already exercised. That means end of the year, there are no options. So when there are no options, how can you say that you can calculate diluted EPS? You cannot. Diluted EPS can be computed only if there are potential equity shares at the end of the financial year. Options jab exercise ho gaye, that time they no longer remain options. Okay. It will go and sit in your basic EPS calculations. Okay. So that takes care of options. Any doubts? Sairam, did you understand? I hope I understood your query and answered accordingly. Okay. Options, everyone understood. So this question is solved for you. This question was already, did I do this question? No, I did not do this question, I think. All clear so far? All clear, guys? Any answers? Tanushri, Vidula, Srinidhi is not there. Yes, all clear? Shall we proceed further now? Okay, Priya has confirmed. Okay, all right. Now, what I'm going to do is, this is done. I will do illustration 10 for you. I don't think I have done illustration 10, right? That's not done. So I will do illustration 10. We'll do it right now. And then we shall move on to the remaining, what you can say, questions. I will leave it for homework because it's repetitive. Okay, so illustration 10. Solve it with me. You should not find it difficult. At 31st December X7 and X8, the issued share capital consisted of 40 lakh ordinary shares of rupees 25 each. Okay. The entity has granted options that give the holders the right to subscribe for ordinary shares between Y6 and Y9 at rupees 70 per share. What is 70? This is my exercise price. This is my exercise price. Options outstanding at 31st December X7 and X8 were rupees 6,30,000. There were no grants, exercise or lapses of options during the year. The profit after tax attributable to ordinary equity holders for the years ending 31st December X7 and X8 amounted to 5 lakhs and 6 lakh respectively, all relating to continuing operations. The average market price of the share for the year ended 31st December was rupees 120 and for the year 31st December X8 is 160. So calculate basic and diluted EPS. Okay. So year ending 31st December 20X8. Basic EPS. Whenever they ask a diluted EPS question, the first thing is you will have to take the basic EPS because apne ko kya samajhna hai? We have to understand whether my dilutive EPS calculation is really dilutive or is it anti-dilutive. If it is anti-dilutive, I will report the basic only. Okay, so you have to consider that in your answer. So therefore, basic EPS will always be your first step. So profit is 5 lakhs, number of shares is 40 lakhs. So rupees 5 lakhs divided by 40 lakh shares. So this gives you rupees 0.125 per share. Second one. Options are there. So we shall proceed to calculate free element in options. Free element in options. So how do I calculate that? Well, I have options outstanding 6,30,000. 6,30,000 shares minus no grants, exercise or lapse of options. The average market price was 120 and I am giving them the option at 70. So if suppose they exercise it, it will be 6,30,000 shares into rupees 70. This is the money that I'm going to get divided by rupees. What is the fair value? 120. 120. And now when you do the calculation, you will get how many shares? 2,62,500 shares. So therefore, third one, diluted EPS. Diluted EPS is start with basic 5 lakhs divided by 40 lakh shares plus. On options, what are you going to save? You are not going to save anything, so that is going to be nil. And on options, how many shares are you going to get on exercise of options? Well, the free element is 2,62,500. So now when you do the calculation, that comes to how much? $0.117 per share. Compare this figure with the basic. Is it lower? Yes, it is. So this will be your diluted EPS. Okay. All right. Can you try for me quickly year ending 31st December 20X? Acha, ye 7 tha, sorry. This is 7, not 8. So do the working for 20X8 and get me the answer, please, quickly. Let me know whether you have understood. Okay. Jay Srivastav, what does negative share imply? Negative share does not really happen. It's like saying, look, on exercise in the earlier example that we did, 12 lakhs. For 12 lakhs, how many shares can I buy back in the market? At rupees 4 per share, I can buy back 3 lakh shares in the market. So I will get 2 lakhs. I will issue 2 lakh shares to the option holder and I will buy back 3. That means I'm buying back 1 lakh extra shares. Okay. Which is not a meaningful figure. Okay. But this is how you can interpret it. Shares 2 lakh minus 3 lakhs. So in fact, you are buying back more, which will not remain in the capital structure. And that is why we ignore the negatives, take it as 0 if at all it turns negative. Okay. So that was your query. Next, any other answers? Anybody tried year ending December X7? Just do it quickly, please. Do it quickly. Anybody got the answer? Basic EPS 0.15. Priya gave the answer. Anybody else who did the workings? This is nil and number of shares is 3,54,375 shares diluted. Compare the diluted with your basic. Is it lower? Yes, it is. So this qualifies as diluted EPS. Yes, Priya Garg's answer is right. All right. Sairam, your query, I hope it was addressed. You had a query. I hope I understood it well. Okay. All right. So let us then proceed to the next question. This is done for you. This is done. I leave this for homework. Very simple question. RTP question hai. I think it's there in the latest study mat also. Just have a look. Same things. Net profit, weighted average number, average market price, shares under option, exercise price. So I don't think I have to do this. Okay. The same thing. Okay. The same question is there here also. Okay. So this also is home. It's the same question. Even figures are the same. Okay. So I'll be leaving that for you for homework. Okay. All right, fine. We now come to this illustration, which is very important. Yes. We now come to illustration 9. Okay. Anybody still solving? Okay. Priya got, Jay Srivastav got, Tanushri, hope you got, Vidula, hope you got. Who else is watching? Kumar Mangalam, hope you also got. Yes. All right. Now, many times, it may so happen that the options which are there are convertible. Second. Okay. Not options. Convertibles. Convertibles means bonds, preference shares. Chalo, we'll take options also because ultimately on exercising, you will convert it to preference shares. Now, many times it may so happen, these ultimately get converted to shares. These ultimately get converted to shares. Now, if you have studied Ind AS 109, if you have studied Ind AS 109 that deals with financial instruments, the ratio of conversion, fixed shares, fixed price, fixed ratio. So if it is fixed for fixed, the conversion terms are fixed number of bonds, preference shares or options getting converted to fixed number of preference shares, fixed price, everything is fixed. If that is the case, then this would be classified as equity. This would be classified as equity. Whereas if it is variable, then it would be classified as a financial liability. We will not get into much of the details in this because this can go into a 3-hour session independently. Abhi ke liye just kind of recall, when it is variable, the conversion ratio, the conversion terms are variable, then you will treat it as a financial liability. However, even in case of variable conversion terms, suppose if the variability is only on account of time, or in the case of a foreign currency convertible bond, in these cases, though the conversion terms are variable, you can treat it as equity. Okay, exceptions to this. Variability is only on account of time. There are other options, but for the next question, this is sufficient for us to understand. Variability is only on account of time. Matlab, if you exercise the option to convert after 1 year, you will get say 100 shares. If you exercise the option after 2 years, you will get 125 shares. After 3 years, you will get 145 shares. So the variability is happening only and only because of passage of time. And therefore, in that circumstance, you can regard it as equity. You can regard it as equity. Okay. You can treat it. However, in spite of that, you may have questions. You may have questions like the next one, which we are going to do, where in spite of it being variable only on account of time, the question chooses to treat it as a financial liability. If that is the case, so be it. We will also treat it as a financial liability. Therefore, in examinations, you may end up having certain inconsistent information. Ho sakta, it can happen. Now, when that thing happens, you have one option that is there with you. You cannot modify the question. So you have to solve the question looking at the facts of the question. However, you give a note saying that, well, ideally, this should have been the way it should have been done. But because the question has specified this, I'm solving it in such a way. So what you're doing, you are not only respecting the question that you have got, you are also telling the examiner, I know the respective Ind AS. The treatment is inconsistent in this question. So therefore, I have solved it in an inconsistent manner. Okay, so that kind of clarifies the thing. So in some cases, in this question which you're going to do, though it is variable only on account of time, the question still chooses to treat it as a derivative. That is basically a financial liability recorded at FVTPL. So if they are doing that, we will also do that. We will not go into many questions. That is the first thing. Second thing, when the variability is there in the case of options, suppose I have one option today, it can be converted into 2 equity shares after 1 year, 3 equity shares after 2 years, 5 equity shares after 3 years. Now the question arises, this is a variable conversion. So far, whatever 2-3 questions that we did, it was a fixed for fixed conversion. इतने options है, इतने shares मिलेंगे, आपको exact number मालूम है. But कई बार क्या होता है, अपने को number नहीं पता. The number is fluctuating. And when the number is fluctuating, you have to give the EPS calculations today. You cannot take it. You cannot say that I will wait until the year passes to see what is the conversion ratio. So what the standard tells, be very conservative. Opt for that conversion ratio which maximizes the shares that have to be issued to the option holder. Okay, so repeat once again, you will consider that conversion ratio which maximizes the instruments, the equity to be issued to the option holder. That has to be issued to the option holder. Okay, so with that background, let us come to our next question, illustration 9. Mark it as important. It's quite important. Okay, thoda sa alag hai. At 30th June 20X1, the issued share capital consisted of 15 lakh ordinary shares of rupee 1 each. On 1st October 20X1, the entity issued 12,50,000 of 8% cash at par. Okay, so this is a loan stock that has been issued. Each rupees 100 nominal of the loan stock may be converted. Now here what they are doing is they are converting the loan stock at any time during the years ended X6 to X9 into a number of ordinary shares as set out below. So how are they going to convert? 30th June X6, each share will give you 1,135 ordinary shares. If you choose to convert on 30th June 20X7, 130, 30th June X8, 125, 30th June X9, 120 ordinary shares. Okay, so this is what is the conversion ratios. You tell me now, answer, are the conversion ratios fixed or are they variable? Number one. If they are variable on account of only time, or are they variable on account of any other factor? Give these two answers. Okay. Is the loan stock conversion ratios fixed or is it variable? If it is variable, is it only on account of time, or are there any other factors also involved for the variability in conversion? Answer. Variable on time factors, variable on time basis. Other factor also considered? No, it appears that it is only on account of time. Into a number of ordinary shares, 30th June X6, X7, X8, X9. So if you if you opt for conversion before X6, you get 135, X7 130. So variable based on time. Variable based on time. Okay. Now, if it is variable based on time, the entity has the option to treat such loan stock as equity. As equity. That is there because it appears that the variability is only on account of time. Okay. If the loan stocks are not converted, they would be redeemed at par. ठीक है, अगर conversion नहीं होता, if conversion does not happen, they would be redeemed at par. This illustration assumes that the written equity conversion option is accounted for as a derivative liability, and marked to market through the profit or loss. Abhi the entity chooses this, the question chooses this. By who are we to discuss this? Hai na? So therefore, when I talk about mark to market, there will be a change in the fair values, and this change in the fair values would be recorded in the profit or loss account. So therefore, the change in the options fair value reported in X2 and X3 amounted to a loss of 2,500 and 2,650 respectively. It is assumed that there are no tax consequences arising out of these losses. No tax consequences means what? These FVTPL losses, mark to market losses जो है, these losses के सामने you are not going to get a deduction for tax purposes. मतलब आपका tax expense कोई change नहीं होगा on account of these FVTPL losses. They do not qualify as deductions for tax purposes. The profit before interest, fair value movements and tax for the year ended June X2 and X3 amounted to 825 and 8,95,000 respectively. Relating wholly to continuing operations, rate of tax for both the periods is 33%. Calculate the basic EPS as well as the diluted EPS. Take 2 minutes, take 1 minute, go through this question, please. Sairam, why did you say other factor also considered? Because the question specifies it or because of any other reason? Go through this question. Yes. Done. So let us start. Calculation of basic EPS. Okay. So 31st December 30th June 20X2. Okay. Profit before interest, tax and fair value adjustments कितना है? 8,25,000, 8,95,000. 8,25,000, 8,95,000 less interest. What is the interest figure? Well, the loans were issued on 1st October 20X1. So they are in issue for a period of 9 months. Abhi yahan pe I cannot apply EIR because data is not given. So I will do the regular coupon rate calculation. Okay. 12,50,000 into 8% into 9 by 12. Whereas here it is going to be 12,50,000 into 8% into 12 by 12. 75,000. And here it is 1 lakh. Before tax and fair value adjustments. 7,95,000. Now see, ideally, I should be deducting fair value adjustments and then calculate the tax impact. But what is the question saying? Fair value adjustments do not have any tax impact. Matlab, that deferred tax calculations will not be applicable in the case of FVTPL losses. Okay, so profit before tax, on this, I will calculate the tax expense. Profit after tax, this is going to be at the rate of 67%. $5,02,500 into 0.67. 5,32,650. And now you deduct fair value loss. Fair value loss 2,500, 2,650. 5 lakhs, 5,30,000. Net profit attributable to equity holders. Veins. Veins कितना है? 15 lakh shares. So that comes to rupees 0.33 per share. Okay. Any doubts in basic EPS? No tax consequences only for fair value losses. That is why they are deducted after profit after tax. Have you understood so far? Okay, that's right. Because that is deducted with the only because it is mentioned no tax impact on fair value gains or losses. If they had to mention there is a tax impact, you would take it in the calculation before tax and do the workings accordingly. Okay, now diluted EPS. Diluted EPS. 30th June X2. $5 lakhs plus. This is your net profit attributable to equity shareholder. Acha, now what are the convertibles? Convertibles mein, first thing is you have that equity share. Okay, that is the only convertible. So you will add back this 75,000, but this is going to be net of tax. So you will deduct the tax element also. Okay, plus rupees 75,000, 1 minus 0.33 plus. And once that is done, you will also have to eliminate the fair value losses. Yes, because now you don't have your instrument. Yes, so rupees 2,500. This whole thing divided by 15 lakh shares plus. Which ratio are we going to take? Which ratio should we take? 135 ordinary shares for each one, or 130, 125 or 120? Which ratio of conversion should we take and why? Which ratio of conversion and why? There are many different conversion ratios. $135, highest being conservative. Bang on. Absolutely right. Okay, so you will take this one. That is 135 ordinary shares. Plus, how many convertible stocks are there? 12 lakh 60 or 12 lakh 50 divided by rupees 100. So 12,500 debentures into 135 shares. 16 lakh 87,500 potential shares. Okay. So here it will be 1687 500 shares multiplied by, can you take it for the entire year? No, you cannot. Are Baba, your shares, your stock itself was issued on 1st October 20x1. That means it was there for only a period of 9 months. So you can also take it only for a period of 9 months. Why? Because loan notes were issued on 1st October as loan notes issued on 1st October 20x1. So that comes to how much? Five lakh 52,750 divided by how many shares? 2765,625. $0.20 per share. Acha, this EPS you will compare with the basic EPS 0.33. Is it less? Yes, it is. So it is a diluted number. Are, have you understood diluted EPS? Yes. Have you understood diluted EPS? Good to see a good number watching. 20-25 are there. Are, have you understood? अपने को समझ में आ गया? Can you try diluted EPS for the next year? Can you try diluted EPS for the next year? Diluted EPS for the next year, please. Work it out. Priya Garg, Vidula, Sairam, Jay Srivastav, Tanushri, Manikanta, if you are there. और कौन छूट गया? Srinidhi is not there. Hello, work it out, please. Jay, did you understand no tax consequence का effect? Starting point will be the basic EPS number, that is rupees 5,30,000 plus. Same goes for shares also. 15 lakh shares plus. Now these are in issue for the full year, so 1 lakh. Plus rupees 2,650. 15 lakh shares plus 1687,500. Now here it is there for the entire year. Compare the EPS 0.3533, 0.19. Is it diluted? Yes. Diluted. Great. So Jay Srivastav got the answer. Sai Ram got the answer. Priya Garg gave me the answer. Brilliant. Tanushri, Vidula, hope you also got. Excellent. Okay. 0.188, 0.19 वो सब ठीक है. Okay. Good to go. Okay. So this is done for you. Very important. Okay. Very, very important. Done? Others, did you do it? Okay, so that is done. All right, great. So now that concludes this question. Let us then discuss this theory, what we have already done fairly. You should be able to go through it. I hope the color selection is clear for you. 1 second. For diluted EPS, you will consider only the free or bonus element in the option. So I have told the way how to calculate, which we have already done. Options generally do not involve any payouts in the form of interest or dividend. But so therefore, adjustment to the numerator would usually be 0. However, if options are measured at fair value through P&L, fair value gain or loss would be adjusted in the numerator. Okay, so this is discussed in detail with you. Okay, now we move on to another 2 to 3 small concepts are there. Yes, 1 second. Okay. All right, fine. Okay. Now, when you talk about presentation of EPS, presentation of EPS के बारे में, if at all we discuss, it is going to be like this. EPS from continuing operations, you will disclose. EPS from discontinued operations, you will disclose. And EPS from total operations. All these things you will disclose. Okay, so when I talk about presentation, it will be continuing, discontinued, as well as total operations. We'll look a small concept. Kumar Mangalam had asked this question in the last class, a question which has come in the December 21 attempt regarding discontinued operations and losses. So we shall now have a look at that concept. Okay, so now let us just take a look at it through this question. I will solve it for you. Assume the following facts for company XY. income from continuing operations is 30 lakhs. Loss from discontinued operations is 36 lakhs. Net loss is 6 lakhs. Okay. So now, continuing operations, how much is it? 30 lakhs. Discontinuing operations, 36 lakhs loss. And therefore, total operations is rupees 6 lakhs, which is a loss. Okay. Net profit attributable to equity shareholders. Okay. Now, weighted average number of shares outstanding is 10 lakhs. Weighted average number of shares outstanding is 10 lakhs. Okay. Your incremental common shares means equity shares outstanding relating to stock options is rupees 2 lakh shares. Okay. So incremental common shares. So they have already calculated the free element, bonus element, everything. And after calculating, that has come to 2 lakhs. Now the question is, you are required to calculate the basic and diluted EPS for XY from the above information. Okay. So when I talk about basic EPS, rupees 30 lakhs divided by, what is the Vains? Vains is 10 lakhs. So that is equal to rupees 3 per share. Okay. Discontinued operations, rupees 36 lakhs loss divided by 10 lakh shares. So that is equal to rupees 3.6 negative per share. And when I talk about total operations, one second. Rupees 6 lakhs divided by 10 lakh shares. So that is equal to rupees 0.60 per share. Now we proceed to calculate diluted EPS. Diluted EPS. Okay. Now when I calculate diluted EPS, I start with basic 30 lakhs divided by 10 lakh shares plus. It is options. So therefore, there is no incremental addition to the numerator. So this is going to be nil. But what is the incremental shares which are getting added? 2 lakh shares. One second. The formatting. Yes. 2 lakh shares. So this gives you how much? 30 divided by 12. So 2.5 per share. Next one is rupees 36 lakhs discontinued operations plus 10 lakh shares plus. Options hai no savings, but shares is 2 lakh shares. So that comes to a loss of rupees 3.60 per share. And then finally, total operations, if we have to talk, rupees 6 lakhs plus divided by 10 lakh shares plus. This is nil. This is 2 lakh shares. So this comes to rupees 6 lakh by 12 lakhs, 0. 1 second, yeah. 50 per share. I have made a calculation mistake here. 1 second. Yeah, this is a calculation mistake. This should be 3 per share. Okay. Have you got these figures? Have you got these figures? Yes. Did you get these figures? Bolo. Did you get these figures? Okay. Yes or no? No answers. Okay, fine. So I'll proceed further. I'll assume that you don't have any problem here. So let us proceed further. Look at this figure. 0.6 was the loss from basic EPS. 0.5 was the loss in the case of diluted EPS. Tell me, what do you mean by diluted EPS? Sir, diluted EPS means that EPS after considering all potential shares. But compared to basic EPS, diluted EPS should be less. Diluted EPS should be less. In this case, in this particular case, the diluted EPS of 0.5 loss is more than the basic EPS of 0.6. The diluted EPS loss of 0.5 is more than the basic EPS loss of 0.6. So what was the thing that we studied? Sir, we studied that if diluted EPS is higher than basic EPS, we will not report the diluted EPS figure. We will report the basic EPS figure. But what Ind AS 33 tells is, Ind AS 33 tells the concept of a control number. The concept of a control number. What do you mean by control number? Ind AS 33 tells, look, there is a control number which you will have to determine. And that control number is nothing but your EPS from continuing operations. Just think of this from the perspective of the reader of financial statements. Reader of financial statements, will he be interested in EPS from continuing operations, discontinuing, or total? Sir, he will obviously be interested. He will obviously be interested in continuing operations. देखो discontinued operations are already discontinued, तो उसमें he cannot be interested. Okay, जो बीत गई सो बात गई. What has gone has gone. That is how discontinued operations are viewed as, and therefore discontinued operations he will not be interested. So total operations will he be interested? Not exactly, because for him, the mirror is continued operations. For him, the mirror is continuing operations. And that is why this is your control number. So control number is nothing but EPS from continued operations. EPS from continuing operations. EPS from continuing operations. And when I look at EPS from continuing operations, I find out that diluted EPS is less than the basic EPS. Sir, if diluted EPS is less than the basic EPS, then you report all these figures. You report all these figures. Sir, why? Because look at the shareholder. He will look at diluted. He will look at continuing operations. He will see the EPS has fallen. So he can make an estimate of, acha, so now my worst possible case, if the business continues further, is my EPS will fall to 2.50 per share. He is not bothered with 3. He is not bothered with 0.5 because they are discontinued. Beat gayi wo. It's already a past now, and therefore he's not interested in that. He's not interested in total operations. He will be interested in continuing operations. As long as there is a dilution in continuing operations, doesn't matter whether there is an anti-dilution in discontinuing or total, you will still report them as the diluted EPS. You will still report them as the diluted EPS. Jay Srivastav, if you read the question carefully, they have told that incremental common shares, that means they have done the conversion and this is the free element. Okay. I told this when we read the question. This is already the free element which they have computed. Okay. Computed free element. So you don't have to calculate it again. Okay. Now EPS from continuing operations. Let us move to the next part of the question. Assume if in the above case, the loss from continued operations is 10 lakhs. Income from discontinued operations is 36 lakhs. In that case, calculate the diluted EPS. Okay. So now this is going to change now. Okay. All right. So loss from continued operations is 10 lakhs. Income from discontinued operations is 36 lakhs. So 10, 36, total operations is 26 lakhs. All right. So rupees 10 lakhs divided by 10 lakh shares. So rupee 1.00 per share. Okay. So this is what is going to be your calculation. Next, discontinuing operations, rupees 36 lakhs. So this is rupees 3.60 per share. And then this is rupees 26 lakhs. So this is rupees 2.60 per share. Next one, diluted EPS, rupees a loss of 10 lakhs divided by 10 lakhs plus 2 lakhs. 0.833. $36 lakhs. So rupees 3.00 per share. And this is rupees 26 lakhs divided by 12. So 2.17. Now, look at the control number. Look at the control number. The loss from continuing operations is rupee 1 per share. The diluted EPS per share in the case of continuing operations is 0.833. And when this is the case, your diluted EPS is higher than the basic EPS from continuing operations. In other words, this is anti-dilutive. Anti-dilutive. Yes. And therefore, what are you going to report? You will not report this in diluted EPS. Basic EPS, diluted EPS, you will report these figures. Why? Because we are following conservatism principles. And therefore, in this case, because the control number is turning out anti-dilutive, the diluted EPS, therefore we will report the basic EPS figures only. Is the concept of control number clear to everyone now? Yes, is it clear? Kumar Mangalam, this was your question that you had day before, on Saturday. I hope it is sorted out. Okay, I hope it is sorted out. Okay, so shall we proceed further now? Shall we proceed further? Arey guys, if you don't respond, I cannot understand whether you have understood. Please respond. Please summarize control number. Okay, fine. So now, EPS from continuing operations. If basic EPS is greater than diluted EPS, that is dilutive. Include potential shares in EPS workings. Even if EPS from total operations is anti-dilutive. EPS from continuing operations if basic EPS is less than diluted EPS. That is anti-dilutive. Anti-dilutive. What are you going to do? Do not consider potential shares. Do not consider potential shares in EPS workings. That is, diluted EPS will be reported same as basic EPS figures. Same as basic EPS figures. How did it become anti-dilutive? Look at this, continuing operations. What is your loss? EPS loss, 1 rupee per share. Whereas your diluted EPS loss is 0.833 per share. Now just look at it. No, is your loss per share reducing or is it increasing? Sir, it is reducing. 0.833 loss is a lower loss. That means if I talk in profit terms, it will be like a higher profit as compared to what you can say basic EPS. So therefore, it is an anti-dilutive concept. Yes or no? Vidula, did you understand now? Did you understand now? Did you understand now? Vidula, hope you understood. Congratulations, Hanumant Reddy, for clearing. Thank you for your compliments. Okay. Vidula, did you understand anti-dilutive? What is happening is loss per share is reducing. Yes or no? Loss per share is reducing. So therefore, is it anti-dilutive? Yes. In the diluted EPS, the loss is lower than the basic EPS. So therefore, it is anti-dilutive. And this is the summary. Have you understood this? Jay Srivastav, did you understand control number? Others who are watching? Please respond. अगर कुछ छूटा है, if I am running fast, if I am not clear, please respond. Tanushri, Sairam, Priya Garg, Vidula, Kumar Mangalam. Have you understood? Sir, it is clear. Okay, Tanushri has confirmed. Vidula, all good to go. Jay, समझ में आ गया? Yes, यार छोटा सा कॉन्सेप्ट है, कुछ खास है नहीं इसमें. ओके, अगर मेरा कंटिन्यूइंग ऑपरेशंस एंटी डाइल्यूटिव होता है, डू नॉट इंक्लूड द पोटेंशियल शेयर्स in your diluted EPS, take it same as basic EPS. अगर मेरा diluted EPS normal है, it's dilutive, then even though total operations becomes anti-dilutive, you still report after considering the potential shares. यहाँ पे देखो, look at this, 2.6, 2.17. It is actually dilutive here. It is actually dilutive. But will you report this figure? Answer is no, you will not. You will report only the basic EPS as the diluted. Why? Because the control number is not total operations. The control number is EPS from continuing operations, which is already anti-dilutive. Okay. All right. I got Kumar Mangalam's answer thrice. But Vidula has still not confirmed. Priya Garg has confirmed. Yes. Chalo, sahi hai. Now we move on to, so this part is done. I think you should be understanding it by now. Okay. We then move on to, okay. Fine. Okay. Two important concepts are there, which we will be discussing now. The first one is EPS with financial instruments. With financial instruments. Okay. Now, so far, whatever questions we have been doing, okay, which involved convertible debentures, convertible preference shares, in all these questions, we ignored financial instruments. Why? Because the focus in this chapter has not been financial instruments. The focus in this case has been understanding earnings per share. So that is why it is important for us to just set aside financial instruments and explain to you the concepts. Now that you are fairly a strong student as far as EPS concepts are concerned, hopefully, okay, we now move on to the next concept of financial instruments in your EPS workings. Okay, so now what do you understand by financial instruments? When you have convertibles, convertibles in your capital structure. Okay. These convertibles have to be treated in accordance with treated as per Ind AS 109. Treated as per Ind AS 109. Now, what Ind AS 109 tells me? Ind AS 109 discusses the concept of compound financial instruments. Compound financial instruments. Now, my compound financial instruments could be classified as broadly under three heads. Broadly under three heads. Instruments which are compulsorily convertible. Instruments which are compulsorily convertible. The other one is optionally convertible. Optionally convertible. And the last one is also optionally convertible. Sir, what are you talking? तब तो दो ही variety हो गए ना? नहीं, दो variety नहीं है. This is optionally convertible with the holder being the one to decide. This is optionally convertible with issuer being the one to decide. With issuer being the one to decide. Now, if I talk about all the three instruments, compulsorily convertible, optionally convertible, and optionally convertible. That is at the option of the holder, at the option of the issuer. Now, when I talk about compulsorily convertible, interest will be paid in cash. Obviously, that is why we call it as a secure or as a convertible debenture or a convertible preference share. Either the dividend will be paid in cash or the interest will be paid in cash, but outflow is basically going to happen in cash. That means you are having an obligation. You are having an obligation to deliver cash. You are having an obligation to deliver cash. And because you have an obligation to deliver cash, the interest outflows will be a financial liability. The interest outflows will be a financial liability. The same principle applies here also. The same principle applies here also. You are obligated to deliver cash. You are obligated to deliver the cash, and therefore the interest element will be a financial liability. What do you mean by financial liability? You have to be given a similar non-convertible debentures rate of interest. Using that rate of interest, you determine the present value of future cash outflows relating to the stream of interest, convert it into present value, and accordingly using the EIR, the effective interest rate method. You remember we used to prepare a loan amortization table. We will prepare the loan amortization table to determine what is going to be the effective interest expense for each year, which will be debited to the profit and loss account. And ultimately in the loan amortization table, the coupon that you are going to pay each year will be taken as a part repayment towards the financial liability. That is essentially what we do. So in this case, the interest would be the effective interest rate. The interest would be the effective interest rate. As far as the principal is concerned, in the case of compulsorily convertible instruments, you will be taking the instruments into equity, and therefore this will be regarded as equity. I'm not saying equity shares, mind you, I'm saying equity. Why do I not say equity shares? They are not equity shares because equity shares means those instruments which have a residual interest in the net assets of the company. It is quite possible these debentures and all do not have a residual interest in the company until they actually get converted. So while they are still convertible, the characteristic is that of a debenture. You cannot make it as equity shares. And that is why when we do our calculation of diluted EPS, we do the adjustment of interest. But when we do the calculation, we only take the potential conversion equity instruments. We do not take the equity rupee value. We do not take the equity rupee value in our calculations. We can only take to what extent it's actually going to get converted into shares. Okay. Optionally convertible debenture, optional at the option of the holder, I will take it as a financial liability. I will take it as a financial liability. Why? Kal ko ut ke, see, if you think that he will convert, but tomorrow if he wakes up and asks for cash, you have to pay the cash. So therefore, you are better off taking it as a financial liability. Whereas in the case of optionally convertible instruments, convertible at the option of the issuer, this depends. This one depends. On what? It depends on the entity itself. Optionally convertible at the option of issuer means the entity will decide whether to convert it or whether to redeem it. Okay. So therefore, if entity lacks adequate cash, for example, okay, lacks adequate cash, will it redeem? No, it will convert. And therefore, that point of time, it can be taken as equity. It can be taken as equity. Example, if entity's promoters want to protect their stake, then they will not convert, they will choose to redeem, in which case it will be a financial liability. In which case it will be a financial liability. In all cases, the facts and circumstances of each case will decide whether the instruments appear to be a financial liability or an equity. And accordingly, you are going to solve it. How the institute has solved? The institute has solved assuming it to be a financial liability. Nothing wrong in that. But I would also like to add that alternative solution exists where you can take it to be an equity instrument and solve it accordingly. Okay. Will you lose marks? I cannot really, comment, but I would say that give an alternative solution. Give an alternative solution. Whenever there are more than one method of arriving at a correct answer with different solutions. Okay. Then it is advisable that you mention that alternative methods are also there, in which case the solution will change accordingly. At least the examiner should know that you are aware about alternative methods. You are aware about alternative methods. Okay. So when I used to do my diluted EPS calculation, I would start with net profit attributable to equity shareholders divided by Vains. You remember this was the net profit for the purpose of basic EPS. Now, if these are financial liabilities, the interest that would have gone in the P&L would be based on effective interest rate. Yes, sir. And because it would have been based on effective interest rate, you will have to prepare the loan amortization table and calculate the effective interest rate for that particular year and add it back. So plus effective interest. Okay, not rate here. Here it is effective interest into 1 minus T. Effective interest into 1 minus T. And in the denominator, will you add the rupee value? Answer is no, you will not. You will add the potential. Equity shares. You will add the potential equity shares that are there in your calculations. You will add the potential equity shares. You will not consider the rupee value. I am calculating diluted earnings per share, not per rupee of equity. I am calculating diluted earnings per share, and accordingly I will base my calculation. So don't get confused when we classify an asset, a convertible as equity component and a liability component. You will get an equity component in rupees. So don't get confused and say, sir, we have to take that equity component in rupees in my EPS calculation. Answer is no. It is per share, earnings per share. That equity component which you have segregated is an Ind AS 109 calculation. You have to segregate it so that you can apply the effective interest rate on the liability component. Okay, so that is why we do the segregation. That segregated equity portion which is there of the compound financial instrument, it has no relevance as far as earnings per share calculations are concerned. That segregation is done to determine the financial liability so that the correct rate or the correct interest expenditure can be calculated. Is it okay? Have you understood the theory? Have you understood the theory? Yes. Any doubt so far as the theory is concerned? Okay. Any doubts? No doubts? If no doubts are there, then we shall take a 5-minute break. We shall take a 5-minute break and then we shall continue after 5 minutes. Okay, it's 9. I think we have still 2 concepts major remaining. The remaining are 2-3 small concepts which should not take much of our time. Okay, so so far, is it clear? When we do the problems, I think it starts to get more clear. Okay, clarity will flow in. I am a little, what you can say, worried that many of you don't respond. Okay, so if you have not responded, then please let me know whether you have understood or not. Okay, because sometimes what happens, I tend to overlook your understanding in the absence of responses. Okay, so just respond if it's all clear. Okay, feel free to answer. Okay, so we take a 5-minute break. If there are any changes you want in the way the session is going on, please let me know. Okay, I'll try to incorporate to the best of my ability. Okay, so now the next 2-3 concepts are quite important. So just attend and then we should kind of manage it. Okay, so take a 5-minute break. We shall assemble at 9:10. It's 9:04 as per my watch. So we shall assemble back at 9:10. Okay. Okay, fine. All right. So welcome back. We were discussing about Ind AS and financial instruments. Okay. So now let us look at how to solve. So basically, compound financial instruments apply financial instruments principles, segregate between equity and financial liability component. Equity component is ignored for EPS purposes. Financial liability component, you will compute the effective interest rate. You will compute the interest based on the effective interest rate, and that interest will be added back in our calculations. Okay, so that is how we are going to solve the remaining 2-3 questions which are there on financial instruments. Okay, so now we come to this illustration. It was there in your RTP also, it was there in your MTP also. So it's a kind of amalgam of financial instruments and EPS. An entity issues 2000 convertible bonds at the beginning of year 1. Okay. The bonds have a 3-year term and are issued at par with a face value of rupees 1000 per bond, giving total proceeds of rupees 20 lakhs. So this is at par. Interest is payable annually in arrears at a nominal annual interest rate of 6%. Okay. Each bond is convertible at any time up to maturity into 250 ordinary shares. So potential shares are how much? Well, potential shares is 250 shares per bond multiplied by how many bonds? 2000 bonds. 2000 bonds. So this comes to 3 lakhs. That's right, 2000 into 250. 1 second. Sorry, 5 lakhs. 5 lakh shares. Okay. All right. The entity has an option. Entity has an option to settle the principal amount of the convertible bonds in ordinary shares or in cash. When the bonds are issued, the prevailing interest rate for a similar debt without a conversion option is 9%. Okay. At the issue date, the market price of one ordinary share is rupees 3. Income tax is ignored. Okay, fine. So income tax is ignored. Calculate the basic and diluted EPS when profit attributable to ordinary equity holders of the parent entity for year 1 is 10 lakhs. Ordinary shares outstanding is 12 lakhs and convertible bonds outstanding is 2000. Okay, so let us proceed with our calculation. First thing, easy marks. This is illustration 14. Basic EPS is equal to 10 lakhs divided by 12 lakh shares. So that is equal to 0.833 per share. That tope which I put on 33 indicates that it is a recurring decimal. Okay, that underline which you see. So that overline, not underline. Okay. All right. So then the next one is diluted EPS. Diluted EPS. Well, diluted EPS starts where basic EPS ends. So this is plus. I know the number of shares potential, 5 lakh shares. From the beginning of the year, so no need of any time wait. It is there for the entire year. Plus, what do I do? Sir, interest is payable at a nominal annual interest rate of 6%. So kar do na, can we do it like 2000 into 1000 into 6%. Can I do it like that? Answer is no. This 6% is coupon rate. This is your coupon rate. Your interest liability is not based on the coupon rate. It will be based on the market rate, which is 9%. And therefore, whenever a question has a market interest rate given to you, it is an indication, it is a hint, it is the question is telling you that you have to treat it as a financial instrument and EPS question and solve accordingly. Okay, so therefore, assuming that entity will redeem the debentures and not convert, what are you going to do? You are going to calculate liability component and equity component. So value of bonds is equal to rupees 20 lakhs. Value, when I say this is the proceeds that you receive, this one let us split between liability component and equity component. In any case, the equity component will be a balancing figure. So liability component is going to be annual interest outflow is to 20 lakhs into 6%. This is the coupon outflow multiplied by, it is an annual outflow, right? So therefore you will be having present value annuity factor discounted at the market rate of 9% for a period of how many years? The bond is there for a period of 3 years. Plus, you are presuming that this bond will be redeemed and not converted. Okay. So therefore, rupees 20 lakhs multiplied by present value factor 9% for the third year. 9% for the third year. Okay. Come on. Can somebody help me with the calculations? Can somebody help me with the workings? What is the present value annuity factor of 9% for 3 years? And what is the present value annuity discounting factor for the third year? This is 2.5312. Okay. So 1,20,000 into 2.5312. That is 3,03,744. 20 lakhs into 0.7721. So 18,47,944. So what will be your equity? Well, that is the balancing figure. 152,056. Yes. So Vidula Deshpande, that's right. You've taken up to 3 decimals. That is fine. Sairam, just check your workings. I think somewhere you have gone wrong in discounting factor, or you should take 9%. Okay. Just check whether you've taken 9 or 6. Okay. All right. So this equity component of 1,52,056 jo hai, you are going to ignore it. Okay. For the purpose of EPS. This is not equity shares. Okay. This is not equity shares. All right. So therefore you will ignore it. Okay. This is not going to go in your denominator, mind you. Okay. Ye denominator mein nahi jayega in diluted EPS. Okay. All right. So now we prepare a loan amortization table. First year ये loan amortization table. Year 1 opening 1847 944, interest at the rate of 9%, 166,315. Paid, this is not needed, but I'm just doing it, 1,20,000. So closing. So 1847 944, 166,315, 1894 259. It's not needed, but I have just prepared. So what are you going to add back? 1,66,315. You will add back only what you have deducted. Have you deducted 1,20,000 in the P&L? Answer is no. You would have deducted it in the loan amortization table. In the P&L, what would have gone is 1,66,315, and therefore that is the figure which you are going to add back. Okay, so here you will add 1,66,315. They have told to ignore tax, so we ignore tax. So 11 lakh 66,315 divided by 17 lakhs. So this comes to rupees 0.686 per share. Compare it with your basic EPS is 0.833. This is your 0.686. It is lower than that. So this is your diluted EPS. This is your diluted EPS. Is it okay? Have we understood this part? Yes. Have we understood this part or not? अपने को समझ में आ गया? Did we understand this? Priya Garg, Vidula Deshpande, Sairam, Jay Srivastav, Tanushri, Kumar Mangalam. Have you understood this? Yes. 166,315 is from this table. 18,47,944 into 9%. Because as per your financial instruments, the interest will be based on market rate of interest, which is 9%. Okay, so this has been expensed in your P&L. 1,20,000 would not have been expensed. Okay, 1,20,000 would not have been expensed. Okay. Any doubts? Can you repeat the liability and equity calculation? Okay, definitely. So the bonds that you have received, the bonds proceeds that you have received is worth 20 lakhs. You are redeeming it at par, so that payment also will be 20 lakhs. Assuming that you are redeeming the debentures and not converting, the liability component will be made up of two cash flows. One is every year you are paying 6%. They have told, okay, every year. Sir, where they have told here, interest is payable annually in arrears at a normal annual interest rate of 6%. So this is basically the outflow that is there. So 20 lakhs into 6%, you are going to pay 1,20,000 each year. And at the end of the third year, you are going to redeem it. That means you are going to pay 20 lakh rupees at the end of the third year. Now, the same instrument, if it was non-convertible, would have fetched 9% rate of interest in the market. Would have fetched 9% rate of interest in the market. Okay. Now the question is, how do I calculate my financial liability? Well, you calculate your financial liability by taking the 3 years same outflow of 1,20,000 discounted to the present value. So that is why you take the PVAF of 9% for a 3-year period in arrears. It is paid at the end of each year. So that becomes the present value of your interest outflow or annual outflow. Plus, at the end of 3rd year, you are going to redeem it. So you will pay 20 lakhs. So 20 lakhs into the discount factor, that will give you the present value of the liability component today. And the equity component is a balancing figure, 20 lakhs minus 1847,944. Now, when you get this 1,52,056, it is an equity component which will go and sit in your other equity. That's it. Uska EPS में कोई संबंध नहीं है. There is no relationship of this 1,52 with the EPS that we are calculating. This is an equity component, mind you. In the EPS, what goes is number of potential equity shares. And the potential equity shares, which we've already calculated, are 2,000 bonds into 250 shares per bond, which is 5 lakh shares, which is what will go in my EPS calculation. So now you got 1847,944 as the value of your liability. On this, the interest would have been 1,66,315. This interest would already have been debited. This interest would already have been debited to the P&L, after which you would have gotten a net profit attributable to equity shareholders of 10 lakh rupees. So if I convert this to equity, my outflow of interest will stop. So what are you going to add back? Can you add back 1,20,000? No, you cannot, because 1,20,000 did not go to the P&L in the first place. What went to the P&L is 166,315. So you will add back 1,66,315. And in the denominator, you will add back 5 lakh shares on conversion. So that gives you 0.686 per share. Okay. All right. Kumar Mangalam, I'll address your query a little later, okay, towards the end of the class, because we are in the middle of discussing something else. I don't want the flow to get lost, okay? So I'll discuss it. All right. So can you repeat? So Sairam, hope you understood. Yes. Okay. Now, alternatively, assuming entity will convert the bond. Now this is not there in your solution, and not redeem. How are you going to do the split? Well, proceeds is equal to 20 lakhs that you received. This one, let me split it between liability component and equity component. So liability component will be only your interest, that is 20 lakhs into 6%. So rupees 1,20,000 into 2.5312, which is present value annuity factor 9%, 3 years. So that is going to be 1,20,000 into 2.5312. So that will be 3,03,744. Will you take 20 lakhs as a liability? No. The intention will be to convert the bond, not to redeem. Okay. And therefore, the balancing figure goes to your equity, which is going to be 20 lakhs minus 3 lakh 3,744. So 16 lakhs 96,256. This is going to be your equity. Is this relevant? It's not. For EPS, it's not. Okay, you will not take this in your workings. Okay. Now when I prepare my amortization table, it is going to look something like this. Year 1, opening 3,03,744, interest at the rate of 9%. 303,744.09. So 27,337. Paid would be 1,20,000. So closing would be calculated accordingly. $2,11,081. And what would go in your EPS? The addition of interest would be 27,337. Therefore, diluted EPS would be rupees 10 lakhs divided by 12 lakh shares. Plus. This will be 5 lakh shares as it is. Only thing is, instead of 1,66,000, here it will be 27,337. And that will consequently also change your EPS divided by 0.604. Okay, so this is what is the alternative. Institute has not done like this, but in exam, if you assume that it will be converted and not redeemed, this is how you are going to do it. Okay, so suppose the question twists it. In this question, they said the entity will redeem, but if they twist it and say entity has no intention to redeem, then this is how you are going to solve it. Okay, this is how you are going to solve. Is it okay? Are bolo. Please answer. Is it fine? Interest as per market rate goes to the P&L. Yes, obviously. So if I have to talk in terms of journal entries, bank account debit, when you issue and get the money, to equity, to financial liability. You are getting 20 lakhs. I'm discussing both the options. To equity, 1,52,056, 1847,944. 1847,944. Whereas here it would be 20 lakhs, 1696,256, 303,744. Interest would accrue for the year. So interest account debit, or what I call finance cost. Which ultimately goes to the P&L. To financial liability, which is in the first case 1,66,315, 1,66,315. In the second case 27,337, 27,337. And when you pay that 1,20,000 coupon, financial liability to bank. 1,20,000, 1,20,000, 1,20,000, 1,20,000. Yes, regardless of whether you redeem or convert, the veins will be added 5 lakhs. Why? Because that is the potential shares in your capital structure. That is the potential shares in your capital structure. Okay, so this is how you are going to kind of solve this question. Okay, so this is done for you. You should be able to understand it. Okay. All right. Now we move on to the next concept. This is RTP, test your knowledge, latest one. Okay. Acha. Okay. So now a couple of things before we move on to question 6. First one, all of us are aware that now we have something known as statement of total comprehensive income. Okay. Statement of total comprehensive income. Normally in India, we call it a statement of profit or loss and other comprehensive income. But in IFRS and foreign countries, we call it a statement of comprehensive income or statement of total comprehensive income. So this is what is the nomenclature. Now, what do I have? Well, the first part is the regular P&L, which is your revenue minus expenses. Okay. So that gives you your net profit. Okay. Tax, wax, sab aa gaya. Okay. Tax and all, everything is coming. Okay. All right. But sir, if redemption will be there, then there will be no equity. That's what I'm saying, Jay. Whether you redeem or not, whatever is the intention, आज के तारीख में, today, do you have potential equity shares in your capital structure? Yes. Redemption will happen after 3 years. I am not concerned what happens after 3 years. Today, do I have potential equity shares in my capital structure? Yes. Whatever happens after 3 years, we will see that later on. But आज के तारीख में we are going to assess. So these 5 lakhs are not actual. This is potential. This is potential. Whereas this 27 would be actual. Likewise, this would be actual. This would be potential. Okay. So it doesn't matter whether you redeem it, whether you convert it, it's irrelevant. Okay. It's totally irrelevant. Today's date, it is potential. You take it in your diluted EPS calculations. Okay. It's irrelevant. All right. Then you have something known as other comprehensive income. What do you have in OCI? Well, you will have reval surplus additions. You could have what you can say, measurement of financial instruments, or what you can say, shares, investment in shares through FVT OCI. Okay, fair value through other comprehensive income. Then you could be having items like AS19 reserve. Okay, employee benefit reserves movements. Okay, what is on account of actuarial assumptions. Okay, so it contains all these items. Okay, and when you total up net profit plus OCI, that gives you your total comprehensive income. That gives you your total comprehensive income. Now the question is, my earnings per share should be based on what? Should it be based on net profit? Should it be based on OCI, or should it be based on total comprehensive income? And the standard is very clear when it says that it should be based on net profit. So your EPS workings are based on net profit. They are based on net profit. not on OCI or total comprehensive income. अपने को उससे कुछ लेना देना नहीं है. Why am I ignoring OCI or total comprehensive income? Look at the nature of reserves. Look at the nature of items in OCI. They are more of reserves and less of your income and expenditure. And that is why it goes into your it is not going into your EPS calculations. EPS is purely a measure of how well you are performing. Reserves and movement between the reserves is not a measure of your efficiency of performance. What is the measure is your net profit. And therefore, the wordings used are net profit attributable to equity shareholders divided by Waynes. They do not say total comprehensive income attributable to equity shareholders. The words used are net profit, and therefore these two things, that is total OCI and total comprehensive income, not considered for EPS workings. It is only the total that is considered. It is only the net profit that is considered in your EPS. Okay, so that is one thing. The next one that we have to understand is parent subsidiary. Who is a parent? Who is a subsidiary? Well, when parent controls the operations of the subsidiary, parent has control over another company. That company is known as the subsidiary of the parent. Now, what do you mean by control? Typically, the definition we have learned in AS 21 is 50%. But when you do Ind AS 103 and Ind AS 110 very clearly defines that control has nothing to do with shareholding. It is basically that characteristic which drives the parent to control the subsidiary, to carry on the operations, to direct the activities of the subsidiary the way it wants. Okay, so that is a separate standard. 110 you will be studying in the next couple of, I think this Saturday or somewhere you will be starting with the consol financials and business combinations. So that time you will study in detail what is the concept of control. But the broad thing is when we have a parent and a subsidiary, what we will be preparing is known as consolidated financial statements, which is a line by line consolidation. We add the assets, we add the liabilities, we do a line by line addition, and finally we prepare the consolidated financial statements. There are some adjustments, some working, some goodwill, etc., but that is not of importance right now. When we prepare the consol financial statements, subsidiaries profits, they belong to whom? Sir, ultimately they belong to the parent. Acha, so suppose the parent has 100% owning in subsidiary. So whatever profit is earned by the subsidiary, everything goes to the parent. And therefore, when we are calculating your EPS in consolidated P&L, when I calculate your EPS in consolidated P&L, it is going to be net profit attributable to equity shareholders of parent divided by number of shares of the parent. I will not add number of shares of parent and subsidiary together. Okay, they are two different companies. So figure aega, that is going to be meaningless. So net profit attributable to equity shareholders of the parent. Now, what is net profit attributable to equity shareholders of the parent? That is equal to net profit of parent plus parent's share in subsidiaries in subsidiaries net profit divided by number of shares of the parent. Number of shares of the parent. So now the question arises, when you say parent's share in subsidiaries net profit, can a parent have an owning less than 100% and still control? Definitely, it can have 50, 60, but like I said, it can also be 30, 40 and still control is visible. That is a separate chapter. But right now, you just understand that it is not mandatory that parent should own 100% of the subsidiary. As long as parent is having a control over the subsidiary's activities, we can say that the parent has a control over the subsidiaries. And when the parent has the control, to the extent of shareholding it has in the subsidiary, to that extent only profit will accrue to it. So for example, parent is owning 55% shares of the subsidiary. Parent is owning 55% shares. That means somebody else is owning 45%. So if parent owns 55% of subsidiaries shares, 45% of subsidiary will be held by somebody. That somebody is known as NCI, that is non-controlling interest. That somebody is known as NCI, that is non-controlling interest. What do you mean by non-controlling interest? These are the shareholders who cannot exercise control over the company, but they have an interest in the net assets, they have an interest in the profits, they have an interest in dividends. Basically, whatever happens in the subsidiary, the NCI are interested to the extent of 45%. So therefore, subsidiary ne jitna bhi profit kamaya, whatever profits are earned by the subsidiary, to the extent of 55%, it belongs to whom? It belongs to the parent. And ultimately, the parent's share in subsidiary belongs to whom? It belongs to owners of the parent. It is like saying, suppose you have Reliance and its subsidiaries. Subsidiaries profit ka jo share hai, which belongs to Reliance Industries, that profit share ultimately belongs to the controlling shareholder, that is the Ambani family. Okay, so that is something like how you could be visualizing it. So when I'm calculating the EPS from Ambani family's perspective, the EPS will be net profit of Reliance Industries plus whatever be the share of profit from the subsidiaries of Reliance. You will add that divided by number of shares of Reliance only. Okay, so that is how you will do the calculation in the case of parent and subsidiary. Okay, so that takes care of our understanding for the purpose of doing this question. Okay, it is an RTP question. It is a very, very important question, and I hope that we are all attentively going to listen to how to solve this. Okay. Now, CAB Limited is in the process of preparation of the consolidated financial statements of the group for the year ending 31st March. The extract is as follows. Profit for the year attributable to CAB, that means the parent, attributable to NCI and total. So 39 plus 342. Other comprehensive income 5,000 plus 0. Total comprehensive income 44 plus 3. Acha, from an EPS perspective, which number is relevant? It is profit for the year which is relevant. So other comprehensive income, this whole row is irrelevant. Total comprehensive income, this whole row also is irrelevant. So these two rows are not relevant for EPS purposes. The long-term finances comprise of the following. 20 crore, right? Yes. Equity shares at the beginning of the year. And the company has issued 5 crore shares on 1st July X2 at full market value. At full market value means not a rights issue. It is not a rights issue. Okay. Rights issue generally happens at a discount. This is at full market value. Anybody can subscribe, and therefore they have come out with an additional public offer, a further public offer, FPO. 8 crore irredeemable preference shares. Irredeemable. These shares were in issue for the whole of the year ended 31st March 20x3. The dividend on those preference shares is discretionary. Irredeemable plus discretionary dividends. Discretionary dividends. What do you mean by irredeemable? Irredeemable means these preference shares will never be redeemed. That means for all practical purposes, they are going to be equity only. The word used is equity. The word used is not equity shares. I'm not using the term equity shares. They are equity, but they will not go in the Wayne's calculation. Why? Because they are not equity. They are not equity shares. They are just equity. Likewise, the dividend outflow is not a fixed outflow like we saw in the previous question. Here the dividend is discretionary. Here the dividend also is discretionary. At whose discretion? At the issuer's discretion. Those who issue the dividends. Okay. And obviously, no, it cannot be at discretion of the holder. Holder को क्या मालूम profit कितना है? Who knows? It is the issuer who knows how much profit is there, how much dividend has to be issued. And therefore, this outflow of dividends is also going to be in the nature of equity. So Vidula has rightly said that both the situations, it is in the nature of equity. It is in the nature of equity. But will you take this rupee value in your Wayne's? Answer is no. Answer is no. They are preference shares only. They will not come in your Wayne's. Okay. Next one. 18 crore of 6% convertible debentures issued on 1st April, repayable on 31st March X5. So 2, 3, 4, 5, 4 years. Okay. Your instrument is there for a 4-year period. Your instrument is there for a 4-year period at par. Interest is payable annually. As an alternative to repayment at par, the holder on maturity can elect to exchange their convertible debentures for 10 crore ordinary shares in the company. On 1st April X1, the prevailing market interest for the 4-year convertible debentures having no right of conversion was 8%. Prevailing market interest rate. So what is 8%? This is your EIR. Okay. Effective interest rate. Using an annual discount rate of 8%, the present value of rupee 1 payable in 4 years is 0.74, and the cumulative present value of rupee 1 payable at the end of years 1 to 4 is 3.31. Read this paragraph again. It says that the holder on maturity can elect to exchange. So who is it convertible? Convertible at option of holder. At option of holder, not at option of issuer. In the previous question, it was at the option of the issuer. We had both the choices. Okay, we could take it as equity, we could take it as financial liability. Yahan pe वैसा नहीं चलेगा. Here it is the holder on maturity who decides whether to convert or not. And therefore, this is not going to be what you can say, can elect to exchange their convertible debentures. You cannot take it as equity. It will be a financial liability. Okay. In the year ended 31st March, CAB Limited declared an ordinary dividend of 0.1 per share and a dividend of 0.05 per share on the irredeemable preference shares. Compute the following. Finance cost of convertible debentures and the closing balance as on 31st March X3 to be presented in the consolidated financial statements. Compute the basic and diluted EPS for the year ended March X3. Assume that income tax is applicable to CAB and its subsidiaries at 25%. Okay. So this is what is your question. Now, basic EPS is equal to net profit attributable to equity shareholders divided by weighted average number of equity shares. Okay, we will do all calculations in rupees in thousands. वो बहुत बड़ा बड़ा figure है. Rupees in thousands should kind of make the figures sound sensible. Okay, nahi to you will end up writing lot of zeros. That's it. Okay, so net profit attributable to the parent. कितना लोगे आप? What is your net profit? Your net profit is 39,000. Will you take NCI? No, you cannot. It's not your profit. It is, like I told you, Mukesh Ambani getting, the Ambani family getting the profit of the subsidiaries. They will get only their share. You and I are shareholders of, let us say, Reliance Digital or Reliance Trends, for example. Yaar, proportionate profit hame bhi to aayega. We are also having right on that profit. So Ambani family cannot say that they have a right on our share of profit. उनका शेयर का राइट तो है. Likewise, the parent company has the right only on the profit that belongs to it. It has no say in these profit figures. Okay, and therefore only one figure is relevant for EPS, that is 39,000. 39,000 minus. Now see, equity shares are done. Then you have a further equity shares on 1st July. Then you had irredeemable preference shares, which are in the nature of equity. So 8 crore, that is 80,000 irredeemable preference shares. Okay. Now, in the year ended 31st March X3, CAB Limited declared an ordinary dividend of 0.1. ठीक है ना? I am not bothered. I am not calculating retention per share. I am computing earnings per share. So what I do with the equity shareholders share, whether I distribute it, whether I retain it, it's meaningless for me. And therefore, what am I going to do? CAB Limited declared an ordinary dividend of 0.1 per share. This you will ignore. But a dividend of 0.05 per share on irredeemable preference shares, can you ignore that? If it were to be a finance cost, you could ignore. But in this case, the preference share is categorized as equity, and therefore, the preference shares are classified as equity, and therefore, whatever dividend on preference shares is there, it would not have gone to the P&L as finance cost. It would go to the retained earnings as an appropriation, and therefore we will have to deduct that to arrive at net profit attributable to equity shareholders. So that comes to 0.05. And how many irredeemable preference shares? Well, I have 8 crore or 80,000 preference shares. So that comes to 80,000 into 0.05 divided by number of shares. Number of shares kitna hai? 20 crore. So that comes to 2 lakhs, and further 5 crores are issued. So 20 crores means 2 lakh shares plus 50,000 shares issued on 1st July. So plus 50,000 into 9 by 12. So that gives you 39,000 minus 4,000, 35,000 divided by 2 lakh 37,500 shares. So that is equal to rupees 0.147 per share. Any doubt so far? Any doubt so far? So far, anybody has any doubts? अरे बोलो. बेसिक ईपीएस समझा अपने को? यस, have we understood? In some cases, subsidiary companies also have some investments in the parent company. Then how can we tackle this situation? Well, you will have to do simultaneous workings. Okay. Normally, cross holdings are done using simultaneous equations. So you can calculate the net profit attributable to equity shareholders as what is my profit plus what is the share of the subsidiary. I will take that in my working. Share of the subsidiary will be subsidiary's profit plus a percentage of holding. Okay, so if I have to elaborate in the case of cross holdings, this is just academic. In India, if you know, cross holdings are prohibited. Okay, cross holdings, net profit attributable to equity shareholders of parent will be computed like net profit of parent plus subsidiaries net profit. Subsidiaries net profit. Now subsidiaries net profit is equal to, let us assume this is 5 lakhs. Subsidiaries net profit in itself is, let us assume, 4 lakhs plus share of the parent, plus it will have share of the parent. So a percentage of parent, but percentage of parent will also have the subsidiary. So net profit attributable to equity shareholders of subsidiary is equal to 4 lakhs plus 5 lakhs into percentage of subsidiaries profits. You do simultaneous equations and you can get the profit attributable. Okay, that is how you do the workings, but that is purely academic. Cross holdings in India are not permitted. How did I get 80,000? That is here beta. Irredeemable preference shares is 8 crores. I am doing all the workings in thousands. Okay, so 8 crore becomes 80,000. Okay, 8 crores became 80,000. On this, the preference dividend is how much? That is 0.05 per share. So 80,000 into 0.05, that gives you this much. Okay. Jay Srivastav. See, this is again, I'm telling you, I am doing the calculation in rupees, in figures in thousands. So remove this. So how much are you left with? Units, tens, hundreds, 1,000, 10,000, lakhs. So not rupees in thousands, figures in thousands. Okay. So all figures in thousands. Okay. All right. So plus 80,000 into 0.05. Have you understood this part? Then we move on to diluted EPS. Before we move on to diluted EPS, we are having convertible debenture. Convertible debenture. कितने का है मेरा convertible debenture? 18 crores. 18 crores. 18 crores rupees in thousands comes to 1,80,000 rupees. 1,80,000 thousands. 1,80,000 thousands. Okay, it is 18 crores. This will be split into liability and equity. Now, the liability component will be interest outflow plus principal. This is at the option of the holder, and therefore you will always have it as a financial liability. You cannot take it as equity. So interest outflow is 1,80,000 into 6% into, this is for a period of 4 years, and they have given the discounting ratio as discounting factor as 3.31 plus the principal you are going to redeem at the end. This is at par, repayable at par. So 1,80,000 into 0.74. 1,80,000 into 0.74. They have given that figure also. Okay, so now when you solve it, you should be getting it as 1,80.06 into 3.31. This comes to 1,68,948,000. So equity will be how much? Well, equity will be the balancing figure. Is this equity figure relevant for EPS? Answer is no. This equity is not relevant, and therefore you can ignore it. When I do my amortization table, year, opening balance, effective interest rate at 8%, coupon, closing, year 1, 2. Opening balance of liability 168,948 into 0.08, 13,516. Coupon is 10,800. How did I get this coupon? 1,80,000 every year, 6%. $171,664 into 0.08, 13,733. क्या लिख रहा हूं मैं? 10,800. 1,74,597. Now, if you look at the question, the bonds were issued on 1st April 20x1. That means this is for the year 20x1x2. This is the balance on 20x2x3. We are calculating the EPS for the year ending 31st March x3. That is why we did the calculation for 2 years. We did the calculation for 2 years. And these are the interest figures, 13,733, which will be added back. And 1,74,597 is the closing balance. They have asked us what? Finance cost of convertible debentures. Convertible debentures and the closing balance. As on which date? 31st March 20x3. As on 31st March 20x3. So I got that finance cost is 13,733, closing balance is 1,74,597 to be presented in the consolidated financials. So wo ho gaya, basic EPS calculated. Now when I proceed to diluted EPS, well, for the purpose of diluted EPS, I will consider this EIR. This was deducted, so this will be added back. Okay. So this is rupees 35,000 divided by 2,37,500 shares plus 13,733 There is a tax of 25%. So 1 minus 0.25 divided by each share can be each debenture can be converted to 10 crore ordinary shares. 10 crore ordinary shares means 1 lakh shares in thousands. Okay. Plus 1 lakh shares. All figures in thousands. Figures in thousands. Okay. So that comes to how much? 35,000. 10,299.75 plus 35,000 divided by 337,500. 0.134 per share. Check this out now. This is your diluted EPS. This is your basic EPS. Is it lower? Yes. So this itself becomes your diluted EPS. Okay. Have you tried to, is it making sense, everyone? Yes. Are you able to understand? अरे बोलो. Are you guys able to follow? Tanushri, Vidula, Kumar Mangalam, Jay Srivastav, Sairam, Srinidhi, if you are there, are you able to understand? Sairam has confirmed. जय श्रीवास्तव, आपको समझ में आ गया? तनुश्री, विदुला, आप है? Are you guys there? Yes. Okay, fine. Kumar Mangalam also has confirmed. So let us move on to the next one. This is complete. Very important question. Okay. Now, ठीक है. All right. Fine. Contingently issuable shares. Okay. We pick up one more important concept, and then there is one subsidiary parent ka chota sa question hai. I'll pick that up and then wind up the session. Okay. This concept which we are going to discuss now is not very complex. It's quite simple, but it is there in Ind AS 33. It is not there in your what you say AS 20. Okay. When we spoke about potential shares, we had discussed one is your convertible preference shares. We have solved questions. Convertible debentures, we have solved questions. Options, we have solved questions. Then we also discussed one thing, that is contingent shares. That is your contingent shares. What do you mean by contingently issuable shares? Shares which are issuable in the event a particular condition is satisfied. In the event a particular condition is satisfied. So when are you going to include those shares? Okay. So now we are going to discuss contingently issuable shares. Shares which are issued when a particular condition is going to get satisfied. Okay. Will it come in basic EPS? देखो, what is basic EPS? Concept की बात करो. What is basic EPS? Basic EPS, does it talk about future or does it talk about past? सर बेसिक ईपीएस तो पास्ट के बारे में बात करता है, इट टॉक्स अबाउट द पास्ट, मतलब इवेंट्स दैट हैव ऑलरेडी हैपेंड, इवेंट्स दैट हैव ऑलरेडी हैपेंड, एंड देयरफॉर ओनली व्हेन शेयर्स आर एक्चुअली इश्यूड विल यू हैव बेसिक ईपीएस कमिंग इनटू पिक्चर. अगर शेयर्स आपके इश्यू ही नहीं हुए, how is it going to affect your basic EPS? So therefore, if I have to talk about basic EPS, it will be included. These shares will be included. Contingently issuable means they will be issued when some condition attached to that is satisfied. Condition could be profitability, targets, opening of retail sites, etc. So when that condition is, it becomes a basic EPS classification. It becomes fit for basic EPS computation. So basic EPS included in basic EPS calculation only when the conditions are actually satisfied. Only when the conditions are actually satisfied. Okay, so you will record it from that period only. The next one is diluted EPS. Sir, diluted EPS के case में, do these represent potential shares? Yes, they are there. You can see from the agreement that shares are waiting to be issued. Convertible, shares are waiting to be issued. Options, shares are waiting to be issued. Yes, so like that, these are also shares waiting to be issued. So from which date will you include and when are you going to include? So what does the standard tell you? All contingently issuable shares, they have an agreement. They have an agreement. Okay, मतलब ये fixed है. Without an agreement, how can you have a contingently issuable shares? You don't have any agreement with Tata. Suppose TCS, tomorrow TCS revenues exceed a particular figure. You cannot go to TCS and say, मेरे को दे दो, I am having your shares. Where is the agreement for contingently issuable shares with you? You don't have. So therefore, in the diluted EPS, include potential shares from first one, date of agreement or commencement of the year, whichever is earlier. Whichever is earlier. There is a very beautiful question. Once we do that, you will understand it. But this is important. You will include the potential shares from date of agreement or commencement of the year, whichever is earlier. But the question is, how to estimate number of shares? How to estimate number of shares? Many times what happens, shares could be issued in slabs. Shares could be issued in slabs. For example, for every profit above 10 lakhs that you earn, you will get 100 equity shares for every 2000 rupees that you earn. तो अपने को कैसे मालूम? How do I know how many shares will be issued? You told you have to include. वो potential है. I agree to everything. But how do I fix the number of shares? How do I fix the number of shares? Do you estimate the likely profits? Do you estimate the future events that are expected to happen? Do you make an estimate of the future events, the probability, and then determine the likelihood of the event being satisfied and then do the working, or is there any other alternative? And the standard tells, do not estimate. Do not make future looking estimates. Do not make future looking estimates. Matlab, if your contingent share agreement is based on profitability in the future after 5 years, for example, then do not estimate that my profit after 5 years will be so much, and therefore include the potential shares or do not. Suppose you have an agreement saying that additional shares 10,000 will be issued to the shareholders if the company makes a profit greater than 10 lakh rupees after 5 years. Sitting today, you should not estimate the profit after 5 years. Nahi to what is going to happen? Huge amount of bias, huge amount of personal interest, huge amount of what you can say, distortion of financial statements could happen, and therefore no forward looking estimates are to be made. Sir, if you are telling we have to include potential shares, you are telling don't make forward looking estimate. So how do I include it in potential shares? You will treat current period to be end of contingency period, and accordingly include or exclude potential shares. Accordingly include or exclude potential shares. Sir, what does it mean? It means that what is your condition? If profit after 5 years exceeds 10 lakhs, I will issue 10,000 shares. Okay. Don't make forward looking estimates. आज के साल में देखो, is your profit more than 10 lakh rupees? Answer is yes. Okay. Do I have a contingent share agreement? Yes. Was it there at the beginning of the year? It was there last year, but I have to include potential shares from date of agreement or commencement, whichever is not earlier. Sorry, this is whichever is later. Whichever is later. Okay. So agreement to last year ka tha, but earlier is commencement of the year. So potential shares have to be included from the first day of the current year. Okay. The contingency condition is profit after 5 years to be 10 lakhs. Standard says don't estimate future profits. Today, this year, assume it to be end of contingency period. Matlab 5 saal beet gaye, assume it as if that is the case. Calculate the profit today. You always calculate. Sir, did the profit exceed 10 lakhs in the current year? Yes. Assuming current year to be end of contingency period, since my profit exceeded 10 lakh rupees, the contingency condition is met, and therefore you will add the 10,000 shares to my potential number of equity shares and calculate diluted EPS accordingly. Okay, fine. ये तो ठीक हो गया. Sir, next year में, year 2, in year 2, let us assume that my net profit is 7 lakh rupees. I did not meet the condition. What the standard tells, assume that current period is the end of contingency period. So now in year 2 end, you will see that your profit is 7 lakhs. It is not greater than 10 lakhs. So are the shares issuable? Answer is no. Will you include it in potential shares of year 2? Answer is no. And therefore they are excluded from diluted EPS calculation of year 2. But wait a minute. Sir, in year 1 you had included. So do you have to do a restatement? Answer is there is no restatement which is required. Why? Because you had made an estimate at the end of year 1 based on the profits of year 1. The facts were there. The facts were totally different compared to year 2. And therefore there is not going to be any case of restatement. There is not going to be any case of restatement that will happen. Okay. So this is how you will do the calculation of potential shares. This is how you will do the calculation of potential shares. Okay. And accordingly, you will present your calculations. Okay, so with that small background, let us try to understand this particular question. It's an easy one. There are not many calculations involved, but there is plain pure application of concept. Okay, so now let us look at this question. Ordinary shares, 10 lakhs. No ordinary shares outstanding during 20x1. 10 lakhs. No options, warrants or convertible instruments outstanding during that period. ठीक है. So it is 10 lakhs. So basic EPS के लिए you will take 10 lakhs. An agreement related to a recent business combination provides for the issue of additional ordinary shares based on the following conditions. 5,000 additional ordinary shares for each new retail site opened. It is only talking about opening a retail site. It is not talking that it should be in function after it has opened till the end of the year. So only opening is important. Functioning till end of 20x1, not necessary. Open ho gaya, that means you are going to be issuing the shares. Okay, so this is known as a retail contingency. This is known as a retail contingency. One shop is opened, 5,000 shares will be issuable. How many shops will be opened? How we are going to decide? We will see in our answer. Okay. 1,000 additional ordinary shares for each 1,000 of consolidated profit in excess of 20 lakhs for the year ending 31st December 20x1. So what is this going to be? This is going to be your earnings contingency or profit contingency. Earnings contingency. Matlab more than 10 lakhs, more than 20 lakhs profit is there. For every 1,000 rupee extra profit, you will give 1,000 shares. Okay, you will give 1,000 shares. Okay, so based on these conditions, look at the facts. Retail sites are opened during 20x1. Two retail sites, 1st May and 1st September. Consolidated year-to-date profit. That means from 1st January till date. So this is your profit of Q1. 11 lakhs. 23 lakhs as of 30th June. This is Q1 plus Q2. That is the 6-month period. 19 lakhs as of 30th September, including 4 lakh 50 loss from a discontinued operation. This is Q1 plus Q2 plus Q3. And then 29 lakhs as at 31st December X1. This is Q1, Q2, Q3, Q4. Okay, so calculate the basic and the diluted EPS. Okay, so simple things first. Illustration 12. Basic EPS. Basic EPS is equal to, basic EPS ke case mein, do you look at potential equity shares? No, sir. We look at only the shares which are already issued, which are already there in the capital structure. We are not bothered with what will happen in the future. So basic EPS mein the total kitna hai, profit kitna hai? 29 lakhs, rupees 29 lakhs divided by, how many shares did I have? Well, initially you had 10 lakh shares. 10 lakh into 12 by 12 plus an additional retail site is opened on 1st May. So for every retail site opened, how many shares? 5,000 shares. So plus 5,000 shares into May na. So May till December is 8 months. May till December is 8 months. And the next one is, the next retail site is opened on 1st September. September, October, November, December. A period of 4 months. So 5,000 into 4 by 12. So that gives you 29 lakhs divided by 10 lakh 5,000 shares. Sir, wait a minute. Profitability you did not see only. Profitability is 29 lakhs. Yes. But if profitability is 29 lakhs, I have to issue extra shares. Profit is more than 20 lakhs. So 9 lakhs divided by 1,000 rupees into 1,000 shares for every 1,000. I will have to issue 9 lakh shares. Wait a minute. When is the profit going to be determined? At the end of the year. End of the year means the first day when you come to know that the profit condition is met, is on the next day. This is on the first day of the next year. End of the year, हम नहीं बता सकते ना हमारा profit कितना है. You may have a very abnormal event that could happen at the end of the year, which could wipe away your profits. Fire हो सकता है आपके major factory में. You could have a tsunami that could destroy your entire factory. You could have an earthquake. So therefore, whether you met the earnings contingency or not, you will come to know on the first day of the next year. And if you have met the contingency, the shares also will be issuable on the first day of the next year. And therefore, are they really issued for the purpose of basic EPS? Answer is no, they are not. And therefore, that retail condition is zero. That condition results in no equity shares. So 29 lakhs divided by 10 lakh 5,000. 29 lakhs divided by 10 lakh 5,000. That gives you how much? 2.89. That gives you 2.89. Okay, rupees 2.89 per share. This is what is your answer. Okay. Next one is diluted EPS. Diluted EPS. Okay. What is your profit? Sir, profit is 29 lakhs. Apna to yahi profit hai. This is what is going to be my profit. Okay. Now, when this is your profit, the potential shares are in the form of contingently issuable shares. So, will they have any impact on your earnings when they become issuable? Answer is no. So, no change in earnings divided by, well, your diluted EPS starts where basic EPS ends. So, divided by 10 lakh 5,000 shares plus. Abhi zara dhyan se suno. Please listen very carefully. This is something which is slightly different. The first retail site opened on May. On 1st of May. That means for 8-month period, it was actually there. This is May to December. If these shares were actually there for May to December, can I say that these shares were potential for January to April? Sir, wo kaise? Are baba, you had a retail condition, right? You had a retail contingency saying that if one store is opened, you will issue 5,000 shares, correct? Assume the end of the current year to be the end of the contingency period. How many shops have opened? Sir, in all 2 shops have opened. So when 2 shops have opened, it means 5,000 plus 5,000. Total 10,000 shares should be issued. Correct? So therefore, from when they should be calculated? They should be calculated right from the commencement. It's commencement or agreement, whichever is later. Agreement date is not given. So commencement is the only date which is given. So ideally, you will have 10,000 shares as potential for the entire year. But Baba, out of 10,000, I have already weighted those 10,000 for time, for the actual time. This is September to December. I have already weighted those 10,000 shares for the actual time they were in issue. And therefore, I will now weigh them for time when they were not in issue, but they were potential. So they are in potential for a period of Jan to April. And then they are also in potential for the second site which was opened. It was potential for Jan to August. It was potential for Jan to August. Okay. And therefore, you will include this. If you take this, it is exactly the same as 10 lakh shares actual plus 2 sites open ho gaya na. So 5,000 into 2. 5,000 into 2 sites. So that gives you 10 lakh 10,000. This also gives you 10 lakh 10,000. Okay. Now, the next thing is retail site to ho gaya. Retail contingency is done. Earnings contingency का बात करते हैं. Let us talk about earnings contingency. When are you going to finalize your accounts? After the year end. After the year end, when you are sitting to finalize the profits, do you know that the profits for the year X1, X2, for the year under consideration, do you know that the profits have exceeded 29 lakhs? Yes, I definitely know. Will you issue the shares by 31st December? No, you will issue it on 1st of April, or sorry, on 1st of January. But when you are finalizing, do you know that in 20X1, the profit condition is fulfilled? हाँ, अपने को मालूम है. So when you know that it is fulfilled, treat the existing period as the end of contingency period. So existing period is end of the period when you make a profit more than 20 lakhs. You have already made a profit more than 20 lakhs, and therefore will the profit contingency also be satisfied? Yes, it will. In the case of potential, it will. In the case of basic, it is not, because the shares will be issuable only on 1st of January, and basic does not deal with potential shares. It deals with hardcore facts. Bhai, is saal kya hua? That is the way you have to calculate your basic EPS. But your diluted EPS, what will happen? Arey 29 lakh profit dikh raha hai apne ko. I am able to see 29 lakh ka profit. And therefore, are these shares issuable on 31st December 20X1? Answer is yes. And therefore, they become potential. And therefore, they become potential. Okay. So this is going to be plus 9 lakhs into 12 by 12. Why 12 by 12? Well, potential shares will be right from the date of commencement or date of agreement, whichever is later. Commencement of the year. Commencement of the year is 1st of January, so into 12 by 12. And now when you do the calculation, you are going to get rupees 29 lakhs divided by 9 lakh 5 plus 10 lakh 5. So that comes to how much? That comes to, 1 second, please. 9 lakh 5 plus 10 lakh 5. 19 lakh 10,000 shares. So that comes to how much? That comes to rupees 29 lakhs divided by 19 lakh 10,000. Rupees 1.52 per share. So this, if you compare, is it a diluted EPS? Yes, it is a diluted EPS. Okay. So ये तो हो गया annual. Now, if the same workings, I take it to a quarterly understanding. Basic EPS, diluted EPS. Each quarter is viewed as an independent period. That's all that you need to know. And each quarter has 3 months. So Q1, that is Jan to March. What is the profit? Profit is 11 lakhs. Here also profit will be 11 lakhs divided by number of shares, 10 lakhs. Are the sites opened? Answer is no. Each quarter is independent. So in this 3-month period, has the site opened? Answer is no, it hasn't opened. So will it affect my basic EPS? It won't affect my basic EPS. Is the profit contingency met? No, it's not. Profit is below 11 lakhs. And therefore, my basic EPS is rupees 1.10. Diluted EPS. Did you meet the profit condition? No. Assuming that the current quarter is the end of the contingency period, my profit is below 20 lakhs. So therefore, no additional shares will be issuable. And secondly, retail site also not open. And therefore, no adjustments. Here, my diluted EPS also will be 1.10. In Q2, that is April to June, what is the profit? Well, the profit 11 became 23. So the incremental profit is 12 lakhs, rupees 12 lakhs divided by, well, I have 10 lakh shares with me. Yes, that is coming from the opening balance. In the month of May, did you open a new site? Yes, I opened a new site. So are 5,000 shares actually issuable? Yes, they are actually issuable. So plus 5,000 shares into May and June. So that is 2 by 3. That is 2 by 3. So 12 lakhs divided by 10 lakh shares. Okay. And now when you talk about diluted EPS, when you talk about, basic EPS, will the shares be issuable on account of profits? See, my profit is 23 lakhs year to date, 11 plus 12, 23. But the condition for issuing is annual profit. Basic will not predict anything. Basic will not predict anything. Basic works on facts. Basic works on facts. And therefore, if it has to work on facts, are the shares issuable now? Answer is no. And therefore, this is what is going to be the basic EPS. 12 lakhs divided by 10 lakh, 3,333 shares. So that comes to how much? That comes to rupees 1.20 per share. That comes to 1.20 per share. Now you come to diluted EPS. Ye to raha 12 lakhs divided by 10 lakh 3,333 shares plus. The retail site opened on 1st May. That means this was potential for the month of April. The same reasoning that we applied for annual, we are now applying it for a quarter. We are now applying it for a quarter. So 10 lakh 3,333 plus 5,000 shares into 1 by 3. So ye to ho gaya mera retail contingency for the 1 month when it was potential. This is for the month of April. And this is for the months of May, June. Okay, this is for the months of May and June. It was potential for April. It became actual in May and June. Okay, so ye ho gaya mera retail contingency. Earnings contingency, 10 plus 12, 23 lakhs. Is my profit more than 20? Yes. Did you meet the condition? Yes. Treat the current quarter as the end of the contingency period. So how much more have I earned more than 20 lakhs? Well, you have earned 3 lakh. So how many shares are issuable to you? Well, 3 lakh shares are issuable to you. So this is going to be 3 lakhs into 3 by 3. From the beginning of the period or commencement agreement, whichever is later. So into 3 by 3. So this is how.
Recording in progress.
हाँ, connect हो गया? Okay. Sorry guys, there was a technical issue. We are back now. Okay. So July to September, my earnings actually became 19 lakhs. It was 23 till the previous year. So there is a loss of 4 lakhs, which is quite possible. Divided by how many shares are you going to take for Q3? Well, 10 lakh shares are already there. 10 lakh shares are already there. Plus, you are also having 5,000 shares of the previous quarter, which are there for entire 3 months. And in the month of September, a new site has opened. So September 1 month, you will have that share in your EPS calculation. So 5,000 into 1 by 3. So this is how you are going to do the calculation. So rupees 4 lakhs loss divided by how many shares? 10 lakh 5,000 plus 5,000 divided by 3. So that comes to 10 lakh 5,000 plus 1,000 167. So 10 lakh 6,667 shares. Well, obviously the basic EPS cannot factor in the earnings right now because shares are not yet issued. So therefore, 4 lakhs divided by 10 lakh 6,667, 397. Okay. And then you are having July to September. Here again, there is a loss of 4 lakhs. Number of shares, well, here it is going to be 10,06,667 shares plus 5,000 shares of the new retail site, which were potential for 2 months, right? They were potential for a period of 2 months. That is August and September. Okay. So this is July, August. And here this is the month of September. Okay. This is July and August. The earnings fell below 20 lakhs. It became 19 lakhs. Assuming end of the third quarter to be end of the earnings contingency period, the contingency is not satisfied, the shares will not be issued. This is what is going to be your calculation. So this is rupees 4 lakhs divided by 10 lakhs. That comes to how much? 5,000 into 2 by 3. 5,000 into 2 by 3, 3,333. So this comes to 10,10,000 shares. So 4 lakhs divided by 10,10,000 shares. This comes to 0.396. It's a loss in both the cases. Acha. Per share. Okay. Abhi you have to just pay one attention. The loss from diluted is less than the loss from basic. But if you read the question carefully, 4,50,000 is loss from a discontinued operation. Total loss was 4 lakhs. Out of that, 4,50,000 is lost from discontinued operation. So 50,000 is the profit from continued operations. And when 50,000 is profit from continued operations, it means that the control number diluted EPS will obviously be less. Why? Because 50,000, if I take the control number concept, ये तो total operations है. This is total operations. Okay. If I take control number figures, it will be 50,000 by 10 lakh 10. And here, 1 second. 50,000 by 10 lakh 10,000. And this will be 50,000 divided by 10 lakh 6,667. Obviously, the diluted EPS from the continuing operations will be lower than the basic EPS from continuing operations. And therefore, the control number is matching where the basic is greater than the diluted. And therefore, you will report this as the what you can say EPS from basic EPS and diluted EPS. आप यही report करोगे, okay? Because the control number is satisfied. So here I'm just writing for you control number condition is satisfied. Control number condition is satisfied. Okay. Then you move on to Q4. That is October to December last year. Now here you have made a profit of 29 lakhs. That is till the Q3 end, your profit was 19. Q4 it is 29. So the profit here became 10 lakhs divided by number of shares. Now here you will be having how many shares? Well, here you will be having 10 lakh shares. 5,000 of the first site opened in March, 5,000 of the second site opened in September. The basic EPS shares will be issued only on 1st of January. They are not issuable on 31st December. Why? Because they are, the profit has to be determined for the year, and that is determined only after the year gets over. So 10 lakhs divided by 10 lakh 10,000. This comes to 10 lakh 10,000. So that comes to 0.99. That comes to rupees 0.99 per share. Okay. Whereas in the case of diluted EPS, 10 lakhs divided by 10 lakh 10,000 shares plus Now, in this case, 9 lakh shares, will it be issuable? Yes. I'm finalizing the books later on. That time I know that the earnings contingency has been met. So these shares are potentially issuable. They are potential shares because the earnings contingency has been met, and therefore you will include the 9 lakh shares here. And you will include it from the beginning of the contingency period. That is, in this case, 1st October. And therefore, 9 lakhs into 3 by 3, that gives you 19 lakh 10,000 divided by 19 lakh 10,000. Your diluted EPS comes to 0.52 per share. Compare it with the basic and you will see that your diluted is lower, and therefore this is your diluted EPS. Now the question that I got is, sir, will months be considered in veins for earnings based conditions? It depends. It depends. See, in this case, it is a coincidence that we got full weight wherever it was applicable, because the date of commencement of contingency agreement was not given. If the date of commencement of contingency agreement was given, I would have to take that particular date, and accordingly, number of months would come for the earnings also, for the earnings contingency also. Okay. So ultimately you have to wait for time. Suppose the contingency agreement came into force from 1st July. All these computations on an annual basis would be only for a 6 monthly basis, because the potential shares would be in existence only for 6 months. So you would be having a time wait depending on the conditions. Okay. Depending on the conditions. So that was a little bit fast, but that concludes your contingently issuable shares. Okay. Now we move on to 2 to 3 small concepts are there. I will just complete that quickly. Okay. I'm a little fast. If you feel any difficulties, you can always revisit the video. Okay. I'm looking at any queries. If you have any queries, please feel free to just type it out. Okay. I'll definitely address it. Okay. Next one is question 5. This is consolidated financial statements. Again, we'll start with the subsidiary. We will look at data of the subsidiary. Then we will move on to the parent. Okay. Subsidiary, exercise price 1 minute. Profit of the subsidiary is 5,400. Ordinary shares outstanding is 1,000. Okay. Next one is warrants 150 exercisable to purchase ordinary shares of the subsidiary. The exercise price is 10. Average market price is 20. Convertible preference shares 400 each, convertible into 1 ordinary share. Dividends on preference shares is 1 per share. No intercompany eliminations. Ignore income taxes and ignore financial instruments. So now your subsidiary. Okay. So first one, basic EPS. What is the profit? This is profit, that is net profit after tax. Okay. So you can take it as 5,400. They have told to ignore financial instruments. So these 400 each convertible into ordinary share. A dividend is being declared thereon. So therefore minus preference dividend, that is 400. That is rupees 400 into rupee 1 per share. Rupee 1 per share. Okay. They have given it to you divided by number of shares. Number of shares kitna hai mere paas? 1,000. So 1,000 shares. 1,000 shares. So now this comes to rupees 5,000 divided by 1,000 shares. So that is rupees 5 per share. That is rupees 5 per share. Okay. That takes care of basic EPS. There is another potential instrument, which is a warrant. How many warrants are there? 150 warrants. Warrants is nothing but an option. So free elements in warrants. is equal to, well, you had 150 shares. Out of 150 shares, the exercise price of the warrant was how much? The exercise price is 20. So the exercise price is 10. The market price is 20. So 150 into 10 by 20. So this is 150 minus 75. So this is 75 shares. This is 75 shares. Okay. And now when I calculate my diluted EPS, I'm having how many instruments? I'm having convertible preference shares. I'm having the warrants also. So rupees 5,000 was my basic EPS divided by 1,000 shares plus the 400 dividend which was there will now be added back. I had subtracted it. Now this will be a savings plus preference dividend of 400 plus in the case of warrants, it is nil. In the case of warrants, it is nil. Divided by preference shares are convertible into 400 shares equivalent and you are having free element of warrants equivalent to 75 shares. So this is 5,400 divided by 1,475 shares. So that comes to 5,400 divided by 1,475 rupees 3.66 per share. These are questions which we have already done. So I was a little fast in this concept. The main important one is that of the parent. Once you are done with this, just let me know if you have understood this. Let me know if you have understood this part. Any doubts, I will be happy to address. Okay. But as of now, have you understood this? You can copy it later or take screenshots later. Okay. Nobody is watching. There are some kids who are watching. Okay. All right. So have you understood this part? Subsidiary ka to it's quite simple. Okay. There is no problem in the subsidiary. It is the parents or the consolidated EPS which is more important. Okay. It is the consolidated EPS which is more important. Okay, you just have to remember these figures, 5 per share and 3.66 per share. Now we move on to the parent. The parent data is like this. Profit attributable to ordinary equity holders is 12,000, excluding any earnings or dividend paid by the subsidiary. Okay. Ordinary shares outstanding is 10,000. This is the parent's shares. Instruments of subsidiary owned by parent. Parent is having 800 ordinary shares, 30 warrants exercisable to purchase ordinary shares of subsidiary, and 300 convertible preference shares. Okay. So when I talk about basic EPS, that is now this is not the parent, but what I would like to call as consolidated EPS. So first one, basic EPS. Here basic EPS mein, I will have the earnings of the parent, which is 12,000. Parent khud kama raha hai. Divided by how many shares? Parent shares is 10,000 equity shares. So there is no ambiguity in this. 10,000 equity shares. Plus. Now when we move on, what all is the parent holding which belongs to the subsidiary? Sir, 800 ordinary shares of the subsidiary it is holding and 300 convertible preference shares. Now see, these convertible preference shares, dividend was actually issued from subsidiary. Yes. So should this be income of the parent? Yes. So when I calculate the basic EPS, I have to take into account whatever earnings comes to the parent. So the 300, because this is excluding any dividend paid by the subsidiary. So obviously now that dividend is income of the parent. So I will add that. So plus 300 preference shares into rupee 1. This is the dividend. Plus, move ahead. He is also holding 800 ordinary shares. Now, each share of the subsidiary is earning the parent 5 rupees per share. And this 5 rupees per share will also belong to the parent. So, therefore, this is going to be 800 equity shares into rupees 5. 800 equity shares into rupees 5. So this comes to how much? This will come to 12,000 plus 300 plus 800 into 5. So that comes to 12,000 plus 4,000 plus 300. 16,300 divided by 10,000 equity shares. So this is rupees 1.63 per share. This is 1.63 per share. I can also get this as an alternative calculation. Look at the profit earned by the subsidiary. Profit earned by the subsidiary is how much? 5,400. Out of 5,400, out of 5,400, out of 5,400, 400 went as preference dividend. So what is the remaining profit? 5,000. Parent is holding 800 out of 1,000 shares, 80%. So this is 4,000. This is how you can get that figure. This is how you can alternatively get this figure. You can do it by any of the methods. Okay. Now you move on to diluted EPS. Now you move on to diluted EPS. When I talk about diluted EPS starts with 12,000 plus parent is holding 800 shares of the subsidiary. Each share is giving 3.66 earnings. Plus, parent is also holding preference shares. Each preference share is convertible into same number of equity shares into rupees 3.66. Plus, parent is also holding how many warrants? Parent is holding 30 warrants. Parent is holding 30 warrants. The free element, now 30 warrants means 30 equity shares, but exercise price is 10, market price is 20. So 30 minus 30 into 10 by 20, free element in the warrants is 15. 15 is the free shares in warrants. Free shares in warrants. So plus I am having 15 shares into rupees 3.66. Basically, whatever parent holds in the subsidiary, each instrument I will take the basic or diluted EPS of the subsidiary, add it to arrive at the total earnings divided by parent's capital structure. Mein to there are no diluted, no potential equity shares. So when you solve this, you are going to get 1100 plus 15 into 3.66 plus 12,000. 16,081 divided by 10,000 shares. So that is rupees 1.61 per share. So this gives you your diluted consolidated EPS. It is lower than 1.63. So when I talk about consol EPS, whatever is the parent's earnings, you will take that. whatever instruments it is holding in the subsidiary, take the corresponding basic or diluted EPS of the subsidiary multiplied by the number of instruments so held by the parent and add it to the numerator. Divide it by the number of shares or potential shares of the parent, as the case may be, to arrive at the basic and diluted EPS respectively. 3.66 is this figure, beta. 3.66 is this figure. Diluted EPS of the subsidiary. Ultimately, these are instruments of the subsidiary, no? So therefore, I am getting the diluted EPS from there. I am getting the diluted EPS from there. Okay. So that is how it is coming from. Okay. So Jay, I hope you understood. I hope you understood how I got 3.66 in the first place. Okay. If this is clear, you should be able to link it up. Okay. So that concludes this also. Now that kind of, finishes the major one. I will be leaving you with one small concept which you have to do. That is participating preference shares. It's quite simple. It's just some equations that you have to solve. I have written the steps for you. So calculate, basically what happens, there may be a case where you are having more than one preference shares are also participating in the profits. So when preference shares are also participating in the profits, how exactly do I calculate the EPS of the ordinary share? Okay, so there are some simple steps which are involved. I would request you to please go through this flow chart. And after going through this flow chart, if you solve these two questions, you should be in a comfortable position to understand this. Okay, वो बहुत ही basic है. It's not much of a difficult thing. You should be able to do these two questions. Apart from that, I think nothing else is left. We have done all the questions, all the concepts. I had a request from one of you, Jay, to solve question number 19 of the illustrations which I had given. I see. Question number 19 में क्या है ना? I was also going through this and there were some errors in the question. Okay. Okay. So this is correct. No, the question is correct. Okay. This is fine. This is fine. This is fine. All right. Now, when I look at question 19, I have a problem with the solution that the institute has given. Okay. I have a problem with the way the institute has given this answer. Okay. I will explain to you what is my understanding. I have also explained the institute's argument also. So I will kind of explain both of them to you. Okay. Rupees 5 was not dividend beta. Rupees 5 is your basic EPS. This is basic EPS, not dividend. Okay. Rupees 3.66 is diluted EPS. Dividend was rupee 1 per share. Okay. Preference dividend was rupees 1 per preference share in the case of subsidiary. Okay. You can check here. It's rupee 1. Okay. Now see, from the following figures, ये गलत है. This should be 20x3. Okay, that's the difference. I have rectified this difference in the solution sheet, but in the question I did not. So that was one change. Net profit for X1, X2 is 75 lakh 50. Next year is 1 crore 25,000. Number of equity shares 50 lakh 250. Bonus issue 1:2. Convertible debentures 1 lakh. Conversion ratio 10 shares per debenture. Okay. Just a minute. Oh, 1 minute. किधर गया? इधर गया. What happened? Not multi-page view, yaar. 1 second. Just a minute. Okay. So this is the question. All right. Now, when I talk about basic EPS for X2, X3, profit, first we calculate the veins. So number of equity shares is 50 lakh 250, which I have picked up here. Yes, 50 lakh 250. So the bonus is 1:2. So 25 lakh 125. For basic, we do not consider potential shares. So ignore potential and ignore the bonus thereon. So number of shares is 75 lakh 375. Just a simple addition of both of them. For diluted EPS, 50 lakh, 25 lakh 125. Potential equity shares. Now see, the debentures were issued on 1st January 20X3. How many debentures were issued? 1 lakh debentures. So 1 lakh into each debenture is convertible into 10 preference shares into 3/12. So 1 lakh into 10, 10 lakhs into 3/12, potential shares 2 lakh 50. I am fine with this calculation also. But what I am not fine with is the bonus. This bonus, what has been done in this question was total conversion was 10 lakh shares. 1 lakh debenture, each debenture getting converted into 10 shares. So 10 lakh shares divided by 2, 5 lakh shares they picked up. And directly they put 5 lakh in the answer. Now this I am not convinced. Reason being, bonus you can get only for the period when you have a right over that bonus. And you have a right on that bonus from the date when your debentures were issued, and debentures were issued only for 3 months in the current year. So as per my humble opinion, it should not be 5 lakhs. It should be, in my humble opinion, it should be 1,25,000. How 1,25,000? Same calculation, 5 lakhs into 3/12. 5 lakhs into 3/12. This gives you 1,25,000. Or you can take potential convertible debentures to shares 2,50,000. So 2,50,000 ka half should be 1,25,000. If that is the case, then these answers will change. These answers will change. It's my humble opinion. I also believe that 1,25,000 is right. 5 lakhs is not right. Now coming to adjusted diluted EPS, again they have taken 5 lakhs here, which I honestly don't subscribe to. In my humble opinion, again, here there were no convertible debentures. There were no convertible debentures. So actually speaking, there should not be any bonus that should be attributable in the previous year. But then my EPS starts getting distorted. My EPS starts getting distorted. And therefore, since these 1,25,000 shares were already there in the capital structure, at the most, I can take 1,25,000 shares only for the purposes of comparability. Otherwise, I cannot even take this, because in the year X1, X2, the reported diluted EPS will not have these shares. I will not modify that, but I will modify the restated EPS to include 1,25,000 shares. And accordingly, these figures will undergo a change. This will change, this will change, this will change, this will change. These also will undergo a change. Okay. Why? Because 1,25,000 is clear, and why it is 1,25,000 in the adjusted EPS of X1, X2 also is clear. So these sentences, however, for bonus on such potential equity shares, I don't agree with this sentence. On such potential equity shares, timing factor should not be considered. Why should not be considered? It should be considered, no? We have studied, it should be considered. So these sentences I don't agree with. Okay, it's my humble opinion. I rest my case with this question. Okay, I don't agree with this. Okay, so ये एक थोड़ा सा it was a problematic question. I understand, but if you have attempted, I'm very happy. Question numbers 20 and 21, please try it out, because I will tell you why you have to try it out. There are many potential shares. You have convertible preference shares, convertible debentures, options, warrants, etc. And you have to determine the dilutive potential share. So you calculate incremental EPS, assign rankings to it, and then calculate the diluted EPS. This question came in the examination, one of these. But a corresponding example is not there in our study module. And that is why I would request you to please try question numbers 20 and 21. It gives you the sequence in which you have to present the EPS. Okay. The sequence which you have to consider for calculating diluted EPS, most diluted EPS, in the case of multiple potential instruments. Okay. So with that, I think, I have fairly eaten up into a lot of your time, extended by 1.5 hours, but I hope it was successful. For restated EPS, bonus should be considered, but only 1,25,000, but only 1,25,000, because ultimately they were already there in the capital structure. No, so we give that benefit of doubt to the standard, because if you look at the wordings of Ind AS 33, it tells us that bonus should be considered right from the earliest period. Right from the earliest period. Only for that reason, the presence of that wordings in the standard, I am giving a benefit of doubt and saying 1,25,000 will come in the bonus calculation of adjusted EPS for 20x1x2. सिर्फ उस एक sentence की वजह से I will include that. But 5 lakhs, I personally don't agree. It has to be 1,25,000 for me. Okay. So that is my opinion. Anybody wants to contradict me or wants to present their viewpoint, you are free to share with me. Okay. We meet the day after tomorrow for Ind AS 24. Promise you that is going to be a small standard, but thoda sa usme it may extend a little bit, but not as much as this. But my submission ends here for today. Okay. If there are any doubts, you can always reach out to me. I'm always available. I think even the email ID is there, fr-final@icai.in. Okay. So please feel free to share your queries here. We respond to these queries. Okay. So you can aram se ask your queries. fr-final@icai.in. Okay. So with that, we end today's session. Thank you for a patient hearing. I think many students left in between, but some of you were there here. So we close today's session with this. Okay. Thank you, everyone. Debentures came into existence. Yes, I understand. But the wordings of the standard are for the bonus shares, diluted earnings, the EPS, the bonus will be considered to be in existence right from the beginning. They have not mentioned anything linked to the instruments that came into existence in the current period. And only for that reason, I am willing to go ahead with 1,25,000 for restatement also. Oh, thoda sa it becomes a judgmental issue. I agree with you. Bonus was not, debentures were not there in X1, X2. How can you have? But if you look at our problems on bonus, normal bonus was not a contractual right in the previous year, but we still used to adjust it, right? So on similar grounds, 1,25,000 should be the bonus for the previous year also. Okay, so that is my submission. I second your thoughts. I'm not disputing that. Even I was confused by the way the institute solved. But after going through the standard, I saw that probably they have taken shelter under those words where bonus is from the earliest reporting period. So if that is the case, I'm okay with that. But 5 lakhs in any case is not acceptable. Okay. 5 lakhs in any case is not acceptable. Okay. 1,25,000 le sakte ho. You can take that. Because they are potential shares. Okay. Debentures जब भी आए तो debentures का potential conversion we are not taking in restated EPS, no? So that is fine. Okay. All right. So that concludes our session. Thank you everyone, and see you day after tomorrow. Okay. Thank you. Nisarg.